We'll get started here in just a couple minutes, everybody. Give folks an opportunity to get logged into our Zoom. If you're joining us on YouTube, hey, welcome. Let me know where you're joining us from, what part of the country. We expect probably around 30 to, somewhere between 30 and 50 people on today. Had quite a bit of folks RSVP. And usually on a free class, we expect somewhere around 50% of people to attend that sign up for it. So that's why we say we'll see somewhere around 20, 25, 30. So, but good morning, everybody. Hope everybody's doing well. Happy Saturday. It's a beautiful day here in the neighborhood in Austin, Texas. Hey, AJ, hope you're doing well. I've got a little bit of a cold I'm trying to wrap up with, so I'm a little verklempt, forgive me. We'll get started here in just a couple minutes. What are some of the biggest things that you're looking to learn? If you're sitting here waiting for us to get started, what are some of the biggest questions you have about note investing? Or three things you really want to learn? Now, obviously, you're not going to learn everything about in a 3-hour class today, but we're going to cover quite a bit of stuff. Actually, not some folks, a lot of folks say that we cover a lot more about note investing and nuts and bolts in our 3-hour class here than most do in their 3-day workshops or 2-day workshops. So we like to provide content that's going to be stuff that you can use and apply it in your business. You're going to walk away here with some nuggets today alone. No matter what niche of real estate you go into, we'll show you a couple things that we do to find and raise private capital, sourcing of deals, just some really great stuff that you can really utilize in your investment strategy. We all need to raise private capital. We're all looking for more deals. If that's what you're looking to do, hey, we can help you out with that. And as always, feel free to make sure that you subscribe to our YouTube channel here at WeCloseNotes.tv while you're there. It's the #1 YouTube channel for note investors. We're coming up on just under 9,000 subscribers and just under 750,000 peeps. Hang on a second. As you saw the cars there, yeah.
I just drove by. I thought,
Yeah,
left a note. They soon got out there and the neighbor.
Yeah, I know, right? Exactly. Yeah, I just peeked at the corner there. I'm getting ready to go live with a webinar here.
Okay,
2 minutes later.
fine.
No, you're good. You're
There's
good.
like 20 cop
Yeah,
cars,
and then they got
5 ambulances.
Yeah, and they got also I think I went to see the thing. They had the fire department, all the guys behind the fire department to get in there, which is crazy. I mean, it's every night somebody dies up there for the most part.
Yeah, they said that a gunshot was going off up in there when I talked to one of the guys. So I don't know. That many ambulances and that many cops. There ain't no telling how many people were down.
Yeah, I know, especially those older folks in there. They don't move around too fast. Probably going, I mean, it's just a matter of time, you know what I mean?
Right.
Yeah, thanks, man. Talk to you later. Good morning, David. Good morning, Ling. We'll get started here in just a couple minutes. All right. Good morning, everybody. Hey, welcome to April's Note Weekend Training Class. We are glad to have you here. We often call this our Note Investing 101 class. It's a great starter class for those of you out there that are looking to dive into the world of note investing, how to become a note investor. Now, note investors kind of fall in a couple different categories. All right, and we'll talk about that of what's available. I'm in a smaller niche inside the note world. Most people, when they think about note investing, they think about, you know, owner financing, buying on terms, selling on terms, creating a note. And that is one facet of note investing. But since 2007, I've been focused on the niche of buying distressed debt, distressed mortgage notes, buying notes direct from the banks, becoming the lender, and then making our money by either modifying the loan, working with the homeowners, working with the borrowers to keep them in the property through some sort of payment plan because we bought that debt at a discount, or working to take the property back if the borrowers will play ball or work with us in some sort of fashion. And over the last 17, 18 years, we've bought over $1 billion in debt. We've bought thousands and thousands of notes all across the country. We've helped hundreds and hundreds and hundreds of real estate investors become note investors and dramatically change their path when it comes to real estate investing. And yes, you can do this on a part-time basis. It does not need to be a full-time basis for you. Now, people ask me a variety of different questions, and we'll get to those questions here over the next 2.5 to 3 hours, maybe 3.5 hours. But I encourage you to ask questions. If you're here live on Zoom, we're glad to have you. If you're watching on the live stream on YouTube, you can ask your questions there. We'll try to monitor as we go, but please keep your questions on point with where we're at. That's the most important thing. And this is going to be fun. You're going to get educated. You're going to walk away with some nuggets that you can implement directly into your class. There will be an opportunity too, if you want to continue learning more about notes. We do have a couple of different things we'll talk about as we get closer to the end about our upcoming workshop in 2 weeks, our Note Buying for Dummies workshop, our monthly membership, or even our one-on-one coaching that we offer investors and are very successful at helping people close on deals. But my name is Scott Carson, everybody. I'm known across the world as the Note Guy. Like I said, I've been buying debt since 2007. I call Austin, Texas home, but I buy in 20 to 30 different states. I've spoken at the National Association of Realtors Conference, hundreds of different real estate expos and conferences, along with dozens and dozens of real estate investment groups across the country. And I'm honored that you would join me here for a couple hours on your Saturday, because it is a gorgeous Saturday here in Austin, Texas, as springtime is coming. I am dealing with a little bit of a cold, so I apologize if I end up sneezing or sniffling, or I don't sound like my normal self. I'll try to avoid any sneezing on camera here for you. But the best thing I can tell you is we're going to go through about 14, maybe 15 little segments here for you to get rock and roll, talking about how we find these, how we fund these, how we flip these. And especially in the non-performing note space, that's my niche. We're not going to talk a lot about performing notes. We'll not talk about owner finance notes. Actually, we're not going to talk about owner finance notes, how to create structured deals like that. That's not what we do. That's not what we focus on. We buy existing debt from banks. We get banks that send us lists of notes every month that we can cherry pick from. And I think it's a smarter, more effective way of being a real estate investor in today's world, especially with everything going on in the market as we go. So let's dive in and get rocking and rolling for you. All right. We have a very diverse crowd join us across the country this morning. So many people outside of Texas, which is great. All across the United States here. We had about 50 people register for the class today. And I know we'll have a bunch of other people join us through YouTube and some other things, and those that watch as well. But our training here at WeCloseNotes.com, it's my company, WeCloseNotes.com, and it's the #1 investor recommend training for note investing. If you're a non-performing note investor, it is the best place to go. Please, I wanted to know how you get banks to send you notes. I will tell you that. It's pretty simple. We'll get into that definitely on the first part of the find side. But like I said, we've helped hundreds and hundreds of real estate investors, not only buy one note, but buy dozens, if not hundreds of notes by teaching them the way and the path of the Note Jedi, basically. All right. As I mentioned, we've got people joining us not only all across the United States, but we've got folks in Canada. Canada is actually our #2 market. We have folks down in Mexico. We have folks overseas in England and Spain and Australia and all parts of Europe, Israel, some folks in the Middle East as well. Follow our training to buy distressed debt at big discounts, and we'll dive into that as well. Just so you know, the great thing about this is you don't have to just be focused on your backyard. I'm in Austin, Texas, a very competitive market. I bought some notes here, but most of the stuff I bought has been outside of Texas. It's better deals, and I buy in bulk a lot of times. I should have done a map of trying to show all the notes that we've bought by mapping them, and it would be completely red in most of the most of the United States there for it. But anyway, let's dive into it. With our first session here, basically, I want to share with you guys that, like I said before, I only have a couple rules. One is ask questions, but keep those questions on point. We will record all sessions and we'll try to break these up in little like smaller segments so you can go back and rewatch this later on. You don't have to watch it from start to finish. You can go to session 13 or session 2, whatever you need. Okay. We want you to respect your fellow investors, and we have the chat role enabled. You can ask questions there on YouTube. Respect your fellow investors. If somebody asks you a question or asks a question on there, feel free to let them respond, but let's not be derogatory. Negativity and rudeness will not be tolerated, and you get booted off. We encourage you to network with us and others. We have our Note Nation Facebook group. We encourage you to go join. Throughout probably the first break we take here in a couple hours, we'll let you basically post your LinkedIn profile so people can go follow you on LinkedIn and network as well. But also, guys, if we've got some time at the end, we'll even open up for you guys to jump on here, depending on how many people are attending live. Let you come and introduce yourself, talk about what you're focused on and what your niche is and what you're looking to do as a real estate and note investor. Okay. There are some other resources for you. If these are free resources, we have, like I said, the Note Nation Facebook group. It's got about 1,000 members. It kind of fluctuates. We have our different Note Night in America webinars and podcast. We do those usually on Monday nights, or we'll live stream a video on Monday nights that's educational for you. We have our number one YouTube channel, weclosenotes.tv. You can go there and learn from about 2,000 long form videos, and we've got a bunch of short form videos as well too for you to learn from. You can also book a call with me at talkwithscottcarson.com. That's my direct booking link, my calendar allows you to get there as well. Now, also, we do have the Note Closer Show podcast, the number one podcast for note investors, coming up on our 1,000th episode here in the next 30 days or so. We're really excited about that. Over 1.5 million downloads. Just absolutely jacked up. It's hard to believe we've been doing that for about 7 or 8 years now, and it's done so well. But the next steps, like I said, we do have our upcoming virtual workshop, 3-day workshop. It's called Note Buying for Dummies. We're running a special for that. That'll be in 2 weeks from today, the weekend after Easter. And we have our monthly membership as well, which is a all you can eat, kind of all you can learn and all you can eat. Monthly membership for just $97 a month, the biggest bang for the buck in the note industry. And then, of course, we have our one-on-one coaching if you really guys want to go and take it to the next level. But I always like to ask this question of folks that are attending. And you can want to type this in the chat roll, ladies and gentlemen, here on Zoom, because I know everybody's a little bit different on what their goal is. What do you want to accomplish here? Why are you here? What's your why? What is it, everybody? Feel free to type it in the chat roll. And it varies. People give me a variety of different whys, right? They're looking for cash flow. They want to create cash flow. They're looking for assets or real estate deals because they couldn't find them in their other classes they've taken. Like I had one guy said, I took a wholesaling course. And that's difficult. And wholesalers right now are very, very scared based on the big lawsuit that's taking place in Arizona right now against this big wholesaling company. An unethical, all right? I get people that reach out to me, I bought 1,000 leads, owner finance leads, and I send out letters to these owner finance sellers or buyers. Nobody would call me, or I was in the multifamily space and I want to find more deals. That's a big thing. They want to be smarter. I want to work smarter, not so damn harder. Okay. I'm looking to boost my income or retirement, looking to pay for my kids' college education. You know what I mean? Or I'm tired of being a landlord. I don't want to deal with toilets, sinks, and trash yets anymore. Okay. Or I've got some money in inheritance or 401k from a previous employer that I want to put to work. Okay. Whatever your why is, we can help. All right. Michael, he's looking to transition into retirement, something to be more effective, replace some income. That's great. Thank you for sharing that, Michael. I'd love to hear your big whys for you, AJ, Arthur, David, Ling. What's your other big whys of what you're looking to do and looking to accomplish in the note space? Why are you here this morning, or why are you thinking or have taken our class? Like I said, we want you to help you, whether you're looking to make $1,000 extra a month or $10,000 extra a month. We've got investors of both sides. I'll give you a great example. We've got different coaching. One of my coaches right now, we've got a guy, Sterling, just closed on a little $8,000 note, but it's going to bring in $300 a month for him for the next 5 to 6 years. He's excited about it. That's a great return. All right. It's almost a 50% return. Whatnot, take that back, 3,600 in the first year. No, it's over 50% return for him in the next 5 years. That's pretty phenomenal. And then we've got another guy, Thomas, out of the oil and gas industry. He's got multi-million dollars. He's looking to buy stuff that's going to return a 12% return passively that he doesn't work doing about a lot of work, and he can make more than double digits returns. Okay. So no matter what your income or what kind of money you have, we've got other folks too that have no money that are buying notes and using other people's money to fund their deals and putting money and cash flow in their pocket. So we're here to help you. Lots of great ways to get things rocking and rolling for you. Arthur wants to build a portfolio or side business. Awesome. Tell me what you're doing right now, ladies and gentlemen. A side build a business. What do you mean by side business? Are you all active investors? You're still working full time? I'd love for you to type that in the chat roll. Working full time, part time investor, or full time investor looking for something new to invest in. You know what I mean? Or I'm a full time employee, a full time job, no time. Arthur says he's working full time. Okay, good. Build a side business, something that's going to cash flow. Maybe you can transition to in the next couple of years. Awesome. Love it. Love it. Love it. Love it. And that's the great thing, ladies and gentlemen, I love about our niche of note investing. It's not a 40 to 80 hour a week. You want to just swap one job for another one. If you want to be passive and only put in 5-10 hours a week, you can do that. If you want to do 20 hours a week, it's great. I don't really put in 40 hours a week. I'll tell you that right now. There are sometimes I work hard, you know, you know, there are sometimes I work on a weekend to look at assets or teach a class. But for the most part, I probably work about 20-25 hours on an average when it comes to what we're doing on a daily basis. Now, there's other things that we do, our podcasts and things like that. But you don't have to work a full-time job to make full-time income. If that's what you're looking for, then you're in the right spot. Okay. And you also don't spend a lot of money on direct mail campaigns that don't work for you. All right. We're going to show you the ways to work smarter, not harder here over the next couple hours. All right, let's get rock and roll here. All right. So the first thing we want to dive into here, besides us kicking it off here, is the different types of notes that are available out there for you to focus on in the note industry. Okay. Now, there's basically the way we rank it, there's two different types of debt when it comes to notes. You have institutional debt and non-institutional debt. Now, what does that mean? Well, institutional debt is stuff that's been created by a bank. It's been originated by a bank or a lender, a licensed lender, a mortgage company. Okay. A non-institutional debt is going to be that's non-institutionally created. Maybe it's a land contract. Maybe it's an owner finance note from one person selling their house on terms. Maybe it's a land note that somebody bought a parcel and they're breaking it up. That would be considered non-institutional debt. All right. Most of the time, we're going to focus on buying on institutional debt because it's cleaner paper and it leads to repeat deal flow. That's what you want when you get into any type of note investing or real estate investing aspect. Is something that's going to feed you on a regular basis, not that you have to go out and find stuff new all the time. All right. There's nothing wrong with buying owner finance notes. It's just it's much harder process to find consistent deal flow, and you got to spend a lot of money on the front end side to get deals to come into you. Okay. Now, there's residential first liens. You can buy those. Mortgages that are performing. You can buy first liens that are non-performing, and non-performing means that the borrower stopped paying. Right. We're usually buying non-performing notes where they haven't paid in 6+ months. Okay. There's also junior liens you can buy, second liens, performing and non-performing. There's a lot of folks looking out for that. We just don't see as much of that as we used to back 10, 15 years ago. I don't buy second liens. The only time I do buy a second lien would be when it's behind my first. Okay. With second liens, you really need to buy 4, 5, 6 of them because 2 or 3 are not going to perform. You're going to have to wait till that borrower either sells the property off, it goes to refi, and the other 2 or 3 you might get reperforming. But you never want to buy a non-performing note behind, non-performing second behind a non-performing first. It's a very riskier spot. It's a riskier position being in a junior lien position, and they're not that big a bang for the buck. Some people like it because you used to be able to buy them at cheaper rates and you get some high returns, but that's not the case. They're not really discounted these days like they used to be in the past. Okay. Big thing in the market right now is distressed commercial debt. You can also buy commercial loans that are performing and commercial loans that are non-performing. There's a whole different asset and animal to buying a commercial note from buying a residential note. Different types of due diligence is a little longer process. Okay. You can still make money, a lot of money with that stuff, but I've always been from the big things like make your bread and butter, the residential notes you buy, and your retirement be the commercial stuff. Yes, you can buy owner finance performing and non-performing stuff, contract for deeds or land contracts, and some folks even move off and sell lease options, which we just don't buy a lot of that. I'd rather be in a first lien position versus a tenant relationship for the most part. So about as riskier as I get would be the contract for deeds, and not really risky. They're with a third party servicing company who's handling the payment stream. If the collateral, the loan docs are all written appropriately, then we're good to go. Okay. Now, where should you focus? Okay. There's always when I talk to people, I'm like, what are you looking for? Are you looking for cash flow? Or are you looking for property? Well, you should always in the note space. The note space is exactly tells you what you should be focused on. Cash flow. When you buy a note, you don't automatically own the property. You own the debt. Okay. And owning the mortgage and notes all about the cash flow aspect of it. Okay. Property can come, but the property is secondary to the cash flow side of the space. You should look for your ROI, return on investment. Okay, that's important. What kind of ROI are you looking for? You know, I was talking with a guy yesterday. He's like, "Oh, I'm looking for 12." I'm like, "Okay, are you using your own money?" No, I'm gonna use other people's money. So, well, then you really need to be looking for deals that are bringing at least 16 to 20% to be able to pay your investor. You also got to look at where you're looking to buy, inventory wise. What type of asset class are you looking for, and what states are you looking to buy in? I get people all the time, "Oh, I'm looking for California stuff." I'm like, well, that's great, but California is not really a great deal. It's overpriced, and for what you could buy one thing in California, you could buy a dozen notes in St. Louis or Kansas City or Columbus or even a couple here in Texas. Pricing varies, depends on how far behind they are, what state it's in, how far along in the foreclosure process, how fast the foreclosure time frame, it varies as well. And then, like I said before, your return on time is important just as much as your return on investment. How many hours per week do you have to put to this? Like, if you want to put 40, you can. But honestly, when you're starting off, you're probably going to be putting in 10 to 15 hours a week. It's a couple hours a day. Okay. And we've got plenty of full time investors or six-figure earning investors that are not putting 40 hours a week. They're putting more like 10 to 15. Okay. Now, if you're looking to make six figures, I highly recommend you go check out this video, 100K in 2022. We've updated the video a little bit, but that's a great video for you to take a look at when it comes to making money. How to create a six-figure income by basically buying one note a month for the most part and doing it for 24 months till you have six figures coming in. Okay. Now, what varies a lot across the United States here, I kind of call it the domino effect, is our foreclosure timeframes. Every state's a little bit different. People ask me and say, well, are you seeing more defaults? Where are you seeing your inventory? So, well, it varies because you never know what's going to go to foreclosure because every state's a little bit different. Texas is fast here. Georgia is fast, but then you also have states like New York, New Jersey that can take 2 to 3 years. It kind of delays things. Foreclosure in Florida can take 12 months or more. So this is why you look at a variety of different facets. The great thing when we get a tape in or a spreadsheet in from a bank, it's going to have stuff in different states majority of the time. So understanding what's going on in that state and that asset will vary as well for you. Now, states will have either one or both types of foreclosures. The first one that usually takes the longest is judicial foreclosure. That's where the borrower is not paying and the lender has to take the borrower to court and go through the court system of judicial process to finish the foreclosure. Okay. And this varies. It's like I said, longer. Usually it's going to be at least $3,500 to foreclose on the faster side, up to like 5 or 10 grand, depending on how long it drags out. A lot of the judicial foreclosures are east of the Mississippi, although you do have like Kansas is a judicial foreclosure state, and California is also a judicial foreclosure state if it's a home state. Okay. You will get a little bit cheaper pricing if you're buying judicial foreclosures because it's a little longer process. Now, of course, if you're near the end of the foreclosure process, it's going to be a little bit more expensive. But if you're just starting like in Florida or Illinois, which can be a pain in the ass, you should get a little cheaper than what you'd be buying for something like in Texas or Georgia, which has the fastest foreclosure states. Non-judicial is where you don't go through the court system. Basically, once the borrower is not performed, whether it's 90 or 120 days, you can then basically go file your notice of default at the public records, go file it wherever the county clerk is, or what do you have to do to publicize it. It's a shorter time frame, like 21 days to foreclose or 120 days. It'll cost you like $1,000 here in Texas or Houston to foreclose, and it goes up from there. It's not usually more than like 2,500 to $3,000. A lot of the states west of Mississippi are non-judicial states. But since it is a faster foreclosure state, you'll often pay a little higher price point for those types of deals. Okay. Now, people always ask me, what kind of licenses do you need to have? And it's a mixed bag. Some states require a license, other states don't require a license. So it all depends on where you're looking to buy at. Okay. Now, the big kind of get out of jail caveat is you're going to be using a third party servicing company to collect on your behalf. You're not going to go out and try to collect. It's not worth your time. You're going to pay a servicing company anywhere from like $25 a month for a performing up to like $95 a month for non-performing to collect on your behalf. And if they're licensed to collect debt in those states that you're buying in, that's the first thing. That usually solves it. There are a few states, though, that require a different type of license. Some states require a separate debt collection license, and there's fees involved with that. Like Illinois, wants you to buy a license, it's more like a permit. It's like a 2-year license for like $750 to be a debt collector there. Okay. Some states are fine with it if your servicer's done okay, and others will want you to do something a little bit more. Like in Georgia, Georgia wants you to become a mortgage broker, unless, of course, you're buying with your self-directed IRA. So if you're buying with your self-directed IRA, you're exempt. But otherwise, you need to have a mortgage broker's license or partner with a mortgage broker to buy the note. Oregon, Washington, Massachusetts, Maryland, these guys require you to have a separate license. Illinois, like I said, debt collection. Ohio wants you to have a separate license if you're buying second liens. Okay. Hey, Albert, good morning. Good to see everybody. Albert there from California. Right. A few more and more states are starting to add that mortgage broker licensing. So it's not rampant. In most of the states that I buy, 90% of them are okay with as long as my servicer is licensed there, or I've paid a little separate fee to be a debt collector in those states. Not a big deal. Otherwise, unless you're wanting to buy specifically one specific state, double check, obviously, with your servicing company. Okay. Laws change, and you'll be notified as things change as well. But, up to date, one of our upcoming podcast episodes will be about all the different state licensing. We're going to do a breakdown, probably a 2-part series on the podcast of the different states when it comes to licensing, what's required, timeframes, and that kind of stuff. Okay. Now, what is available in today's market? Okay. What is available? There's a lot of stuff available today. Okay. There's reperforming notes. This is a desirable asset where somebody bought a note that was once non-performing. Investors like me bought a non-performing note. We worked with the bar, got them back on track. They brought some skin in the game, and now they've been paying on time for 12 months or longer. You could buy that note at almost a double-digit yield, if not more. Non-performing, that's our bread and butter, where people haven't paid in 90 days or 6 months or 6 years. Okay. You can buy contract for deeds. You got to be careful in a few states, but contract for deeds, which is basically you're buying this land contract or where a firm has an REO, usually low value properties where the owner finance it to a borrower. The borrower comes in, puts a little bit of money down. It's at like a 9.9, 10% interest rate, and it's financed over 30 years, but the deed stays in the name of the owner. The borrower does not get the deed changed over to them until they've paid off the contract. So that's what they call a contract for deed. And in a lot of states, it's a contract for deed. So treated as a tenant relationship, so it's faster to evict versus foreclosing in some cases. Some states treat a contract for deed the same, like Florida, they treat the same as a mortgage, so you're just going to have to foreclose. But there's some opportunities there on some lower value stuff. Plenty of non-performing commercial notes, very rampant out there. Multifamilies, strip malls. It's so dependent on what the asset is going on here. It's, what the bank is doing. So don't ask me, what kind of pricing can I get? I'm looking for a 100-unit apartment complex. Well, that's great. You got to treat it a little bit different because you're the bank. You don't own the property. Okay. That's one of the big things. I had somebody want to argue with me the other day. Oh, I want to buy apartment notes. Well, what are you trying to do? Well, I want to own the apartment. Well, you're not going to own the property because you're the bank. You have to go through the foreclosure process. And they just couldn't seem to get through their head. I said, it's a little different process going through if you're wanting to buy in one specific state. It can take you a while. Well, we're just going to offer cash to the bars. Well, that's good. But they're collecting rents and not being enforced on it. You're going to have to do some stuff that's a little bit different to take that property back. You don't own the property right off the bat when you buy the note. Okay. There are some different websites out there, platforms that have some older notes that have been hanging around there, some owner finance stuff. There's not really an MLS when it comes to non-performing notes. Okay. There's a few smaller websites that will have some different inventory from time to time. But what has happened is like it was when I got started, you've got to do the outreach through LinkedIn, email, phone calls to find the best stuff and find some really good deals. It's not that difficult. We'll show you how we market smart, not difficult. No direct mail. We want to work more efficiently and less costly, but it does take a little WORK to go find some great deals. But a whole lot easier to do than just sending out postcards or letters. Okay. You also, if you advertise that you're a note buyer, you post it on LinkedIn or Facebook, you'll get people that reach out to you to buy their owner finance notes. All right. Hang on here. Oh. And there are Facebook groups out there. You can see plenty of these owner finance notes, note sales out there as well. People publishing newly originated notes. I don't buy newly originated for the most part. Just doesn't make sense for me. I want something that's a good, usually good deal, good yield. Okay. Most important thing you have to keep in mind is when you're getting to become a note investor, you have to have it's a different mindset. It's a mind shift. A lot of us come up looking at property. We're going to buy property. We're going to rehab and fix it and turn it into a rental. Well, when you're buying notes, the biggest mistake you make is treat that deal like it's a real estate deal. You have to realize that you have a banker's mindset now versus a fix and flip mindset. Bankers looking at that note for cash flow. What can I buy it at? And what's it going to throw off as far as cash flow? If it's not throwing off cash flow because the borrower's not paying, then what am I having to go through the process to get to cash flowing or to take the property back? Okay. And we've had deals that basically we were in and out of in 2 weeks. We've had deals that have taken 4 or 5 years to get out of. Because of foreclosures or drop dead. The biggest mistake I made was trying to treat my note deals like real estate when I first started. The first 2 years, I was foreclosing on everything. Well, I left a lot of money on the table because I didn't modify a lot of stuff that I could have to bring in cash flow immediately. And then I could have sold the asset off in 12 months at a premium without having to bring any attorney fees, holding costs, and then rehab costs. I could have rehabbed the borrower versus rehabbing the property. Okay. Realize that you're buying the note, not the property. Quit chasing equity. We don't really chase equity deals here. Sometimes we'll get them. But if you're looking at, oh, there's a ton of equity in that deal, we don't own the equity. The equity belongs to the borrower until we've taken the property back. You're going to streamline your products or your niche focus, bread and butter assets. Like I focus on 3 bedroom, 1 bath, 3 2s, 4 2s, single family homes, some condos, clean stuff, not none finished stuff, not weird stuff. I don't mind condos. You just got to know where to buy. You got to be careful in Florida. But I prefer single family homes or duplexes or triplexes and stuff like that. Now, yes, we look at commercial stuff. It's a whole different ballgame. But we're not going out chasing huge $1 million properties most of the time. Okay. Occasionally we'll buy them if they fall in the other aspect of things, but we try to streamline it and make it very simple. Real estate investors, we have a hard time avoiding shiny objects. We all will chase the newest and the flashiest thing. You want to pull out that gun and shoot that squirrel. Okay. Focus, focus, focus. Give your business time, give your marketing time to develop leads and return. Too many times, real estate investors goes from one strategy to another strategy to another strategy because they don't give enough time for their seeds and marketing to sprout, or they're impatient and realize that you have to work at something. WORK is not a dirty word. Okay. Like I said, your cash flow, the ROI cash flow should be your number one priority. If it's an occupied asset, if it's a vacant asset, it's not going to throw off any cash flow. It's going to be something you end up foreclosing on, either taking back or turn around selling and fixing up. Or if you want to originate your new note or turn it into a rental, that's your choice. That's not mine. But cash flow should be number one priority. Like I said, buying a note for cash flow is number one. The foreclosure side, fix and flip is the secondary, and going from there. Okay. Any questions before moving on to section 3, everybody? I'm not bashing fix and flipping. I'm not bashing owner financing. It's just the numbers don't lie. Math does not lie. ROI does not lie. All right. And that's why we like to buy stuff that we can get reperforming. If it won't reperform, then we'll look to foreclose and sell it off and get our capital back and then go double down. Okay. let's dive into where we find note sellers. Now, there's a variety of different note sellers. And AJ asked me, how do we get banks to send us notes? And we'll tell you that. Okay, this is where you want to pay attention. Different ways to find note sellers. Now, obviously, banks are number one. There's some different departments inside the bank we'll discuss in a second, but we get our notes, our non-performing list of notes from banks. We get them from mortgage companies or lending institutions. Mortgage bankers definitely will have stuff they've taken back. Servicing companies, there are some servicing companies that have trading platforms where they have a trader on staff that helps them move their clients' products when the clients are looking to sell off. You can go to different conferences and conventions. Sometimes you'll find stuff there. And I'm not talking like small conventions. I'm not like talking like 200 people or less, like Note Investor Summit in Phoenix, or like the Distressed Mortgage Expo in Nashville. You're not going to find a lot of product there. I'm talking more like going to like a Mortgage Bankers Association or a special servicing, or even like IMN would probably find better stuff at those places. But it's still good to go to every once in a while. LinkedIn is one of our number one spots to find it because we're connecting with the right departments, the right people who have notes available for sale. And then also we've built a large network of private sellers because we've been around for a while. People that we know have stuff, they've bought notes, they've, like you and me, they've bought a portfolio of 100, 200, 300 notes and looking to move some of that stuff. And so we're dropping an email blast out to our network often leads to us find some really great deals coming in. And of course, you can always use good old faithful the county clerk to go find different notes that have been created or sold. And there's an assignment of mortgage on a note that is created when a mortgage is sold. And so if you go to the county records and do a assignment search, you can see all the notes that have been assigned from one lender to another lender, how they've been sold over time. So that's one of the things that we like to do is go track assignments at different counties. And of course, if you're looking for distress notes, you can always use the foreclosure lists. You can use the Roddy list here in Texas. You can use County Records Research on the West Coast. You can use foreclosure.com. As long as that list that you buy shows who the lender is, that gives you an idea. Okay, that lender has these distressed debt, these distressed mortgages that they're foreclosing on. They're going to have more a little further the pipeline. So we use foreclosure lists to either contact the bank directly or contact the attorney and go through the back door that way. Okay. And we did a whole long finding deals webinar, much longer than I'm going to go through this here at this bit.ly finding note deals for you guys to take a look at. Okay. It's probably about time to update that. We'll probably do a new podcast episode in the next couple of weeks about that as well. Now, as I mentioned a few minutes ago, there are different departments inside the banks that handle the note sale side of the business, right? The biggest one with your larger institutions they'll have a department called the Special Assets Department. Okay. You want to talk to a special asset manager. Okay. We'll search for LinkedIn for special assets manager to find people who handle this type of job title, or their job description is to sell off notes. Okay. Or distressed debt. They also go by secondary marketing managers or the secondary marketing department. Banks and real estate investment trusts have a secondary marketing department. Now, I don't call customer service and ask to speak to the note sale department. That's not going to make any sense. If I'm calling a bank or a lender, I'm going to want to speak to somebody in one of those two departments. Okay. Now, insurance REITs also will often sometimes have their department labeled as the whole loan sales department, where they're buying large portfolios of notes, or they're looking to sell off large portfolios of notes. This is the third size. It's a little bit smaller list when you search on LinkedIn for whole loan sales versus secondary or special assets. Okay. And then you can also look at the chief credit risk officer. This is going to be on your smaller to regional banks, credit unions. I don't really chase credit unions. I prefer to chase banks that have at least 5 branches or greater, because they'll often have a bigger portfolio that they can afford to sell some off at a discount. If you're dealing with like a one-off bank, it's only got 1 or 2 branches, they're not going to be able to sell that note at a big discount because they just can't take the loss. Okay. But if you learn anything from me today, you may want to take a snapshot of that screen. Those are the 4 departments that you want to search for: special asset managers, secondary marketing manager, home loan sales, chief credit risk officer. These are the 4 departments inside of banks and lenders that sell notes or handle the note sales portfolios. Okay. Now, some websites to help you find notes. There is laneguide.com. This is a service that we subscribe to, I don't know, probably for over 10 years. It tracks bank's internal departments, what bank bought what bank. So it helps you kind of track when you're looking at an assignment that's old, who bought that bank and who do you need to reach out to. Bauer Financial publishes the quarterly FDIC reports that banks have to file in order to keep their FDIC insurance. And this will show you banks that have what their portfolios that's in distress that are behind the upcoming portfolio that's 30 to 89 days behind. They'll break it up by commercial, residential, what kind of percentage of the portfolio, dollar amount of the portfolio the bank holds. It's a pretty efficient list. Lane Guide's like 165 a year. Bauer Financial is like $300 a quarter. And we'll usually reach out to Bauer Financial and have them say, give me a list of the banks with 5 or more branches that we can start tracking. Okay. You always go to fdic.gov and search there. There's a service called Distress Pro or Bank Prospector. It also goes by that tracks the FDIC quarterly reports and gives you some information on there. I like going to Texas Savings and Mortgage Lending Department here in Texas because Texas is the fastest foreclosure state in the country. So it's very friendly to lenders. So we get a lot of banks, lenders from outside of Texas doing business here in Texas. And you can download a registration list from the mortgage, the Texas Savings and Mortgage Lending Department, basically for free. They'll send it to you. And it gives you emails, names, phone numbers that you reach out to. We'll put that into a drip marketing campaign. Other state licensing websites too will allow you to go there and down like Florida, Illinois. A lot of states though have moved to the national mortgage loan originator service basically. So it makes it a little difficult to find who's in that specific state, but I like doing this because it makes sense and get a whole list of people. I can go to the MLS and do a full list of servicing companies. And it'll give me about 190 to 200 servicing companies that I reach out, who's in charge of business development, who's your loan trader. Okay. Scotsmanguide.com has been pretty good in the past. They just changed up their website a little bit. So it's harder to find like subprime borrowers on that aspect aside, which is what I use Scotsman Guide for years. Subprime, Alt-A, non-A plus paper. We would find people originating that and then reach out to them to buy their notes. Scotsman Guide allows for you to put some scenarios in and it spits out kind of a different lenders who do that, especially in the commercial. It's still a little easier to use for commercial to find commercial lenders, portfolio lenders, not so much with the residential side. It's a little bit different. Now, there are some platforms you can take a look at. Of course, there's PaperStack out there. I think I looked the other day, there's like 130 notes on there. A lot of it's owner finance, a lot of it's land loans. It's okay. I've never bought anything on PaperStack. I've always found better deals by being direct to the sellers or going and finding out buying the whole portfolio that one investor might have. Watermark Exchange really isn't doing much these days. Probably need to take that list off, but that was a website that was around a few years back. Val Satir did a really good job selling notes. He still moves some notes from time to time. SN Servicing Company is a big servicing company. They've got a trader. If you go to SN Servicing, their website, and look for investors, there's a NDA you'll fill out. And then David Polio over there is their trader. He sends stuff out on a pretty regular basis. You can go to Dev Expert. That's another website that's been around for a little bit. They've got some stuff. It's all right. Fixed Notes. They've got some stuff. It's usually a lot of junk on there. Second liens. It's okay. Exchange.Notes, my buddy Michael Saucedo. He's basically selling commercial notes. There's some residential, but mostly commercial notes. He's working with a lot of the banks. He used to work for auction.com on the commercial side. And him and his business partner started Exchange.Notes a few years back, and they've done a really great job. Okay. 10xauction.com, you'll see notes on there for sale, commercial properties on there for sale. Well, I don't bid on auction.com or 10x. I go pull up who the property is and find out who the lender is on it, and then I contact the lender directly to see what else they have across the country. Okay. Mission Capital Advisors, they're kind of the big boys along with DebtX and moving stuff. You usually got to register on there and they'll have portfolios. Note Trader Exchange is another website that's been bouncing around for a little bit. Supposedly has some stuff. I've never bought anything from them. But, like I said, I deal directly with banks and different hedge funds, and we reach out to those guys who send us our list on a regular basis. Makes it a little bit easier. Okay. Now, people ask me, what do we say to get banks to send us lists? Well, first of all, you got to get the right department, which is what I discussed in this previous session. Getting to the right department and knowing what to say, what not to say and be very helpful for you. Okay. So there are things you want to say and things you do not want to say when talking with asset managers to get them to send you notes. Okay. You're going to have a basic elevator pitch like in anything else. What do you have in your books that you're looking to move? Are you the right person at ABC Bank that handles your note sales? If you are, great. What do you have in your books that you're looking to move this quarter? My name's Scott Carson. I'm with a company called Inverse Asset Fund or Inverse Investments or WeCloseNotes.com. I've been an active note buyer for years. I'm looking to buy for my own portfolio. All right. Okay. We're looking for something with some hair on it. Non-performing, we prefer. Our goal is if we can, we'll try to work out with the homeowners if we can. If not, we'll go the foreclosure route. And we're looking to buy in most of the major markets across the country. That will work better. You do not want to, I'm looking to buy just buy in Austin, Texas, or I'm just looking to buy in Nashville, Tennessee, or I'm just looking to buy in California. You don't want to say that specifically. If you're just looking for one little city in your backyard, then go do something else. Okay. Unless you're living like in Ohio, Michigan, Indiana, and Florida, where there's a lot of inventory there, then it's okay just to buy in that state. But don't get so niched down to like one zip code or one city. The goal here, ladies and gentlemen, is to get the bank or the asset manager just to send you the tape, and then you can cherry pick from that list and tell them, okay, I'm going to buy these 2, or I want to make an offer on these 5. All right. But you never also, there's things you do not want to say. Okay. I have 20 million a month to buy. They don't believe that. Okay. If you do say that, be prepared to create, to share your qualified institutional buyer form, your QIB form. Okay. If you're gonna buy that much, most of the time, people that have 20 million a month to buy are not the person calling the banks. They're going to have a team that's doing it. Okay. Don't say I'm looking for notes and foreclosures or notes and REOs. What's going to happen when you call the main corporate office on a lot of these banks? You're going to talk to an operator, switchboard operator. I'm saying somebody who's the main operator, and they're going to put you in the directory. If you say notes and REOs, they're going to send you to the REO department, which is basically just a voicemail box. Okay. That says call the listing agent. I'm looking for non-performing notes for my own portfolio. I'm looking for just notes, non-performing residential or commercial notes. Now, they will often sometimes have, actually, all banks will have a residential asset manager and a commercial asset manager. So be specific that way. Okay. Do not say I'm looking to broker or wholesale. You will get blacklisted. They'll hang up on you. They do not need brokers. They don't need wholesalers. I know we get a lot of people that get into this. I want to wholesale notes, and that's okay. But for all the work you're going to put into wholesaling as an exit strategy, you might as well put that work into raising capital. Same skill set, same activities, but when you raise capital, guess what? You now have money to buy the deals and make more returns than basically a broker waiting fee. Okay. Never say I represent a buyer. I'm a buyer's rep or buyer's mandate. That'll piss people off because they'll throw up about it. And here's the thing, another thing, don't say I'm looking for anything non-performing, residential, first, seconds, juniors, whatever it might be. Be specific. Hey, I'm looking for non-performing first liens. I'm looking for assets that are between $50,000 and $500,000 for the most part in most of the major markets. Okay. That's the important thing to say. Get them to send you a spreadsheet, your list, the Excel tape, whatever it is. Get them to send that and you cherry pick it. Okay. That's what it comes down to. You make it simple where all you do is, okay, this guy or gal sounds like they know what they're doing. Hit the download button and attach it via email. Okay. Now, there are better times to email asset managers or to call. This is the most important thing you got to realize. You're going to have to follow up with these people. You're going to leave a lot of voice messages. You're going to shoot emails and drip market to them on a regular basis. But you want to be specific when you send out emails so it shows up in their inbox. Okay. Send emails to people on Tuesday, Wednesday, or Thursday. That's the best open rates. Wednesday afternoon is the best open rate for emails across the board. Okay. Tuesday morning works well. Wednesday afternoon works well. Wednesday morning, AM or PM on either of these 3 days works fine. Okay. But you wanted to go out between 10 a.m. and 3 p.m. because what will happen if you send it out earlier than that, it's going to get buried by emails coming in. If you send it out later than 3 o'clock, they're going to be out the door and it's going to be buried by everything they receive over the evening or over the weekend, right? So 10 a.m. to 3 p.m. Tuesday, Wednesday, Thursday. The first time you send an email blast to asset managers, you get about 10 to 20% open rate, depending on how big your list is. Okay. You send the same exact email a second time to those that didn't open the first time, you'll see a 5 to 8% open rate. And we do it again the third time to the same list that didn't open, you see a 1 to open rate with a third email. And you do this every month. It's a drip marketing campaign, an email out. Those that open the email, you put them in a hotter list. Okay. And the goal here is if you send an email on Tuesday, follow up on Thursdays that didn't open up. Okay. You send an email out Thursday, follow up with an email on Tuesday. So if you send one on Thursday afternoon, send it Tuesday morning. Okay. If you send it Tuesday morning, send it Thursday afternoon. If you send it Tuesday afternoon, send it Thursday AM. Does it make sense? Okay. Now, if you're going to call, which is, I highly recommend you do, besides sending an email, go those that opened your email and then going over to LinkedIn and finding them. If you've got phone numbers, pick up the phone and call bankers. Okay. Call them Tuesday, Wednesday, or Thursday. 10 a.m. to 10 a.m. to noon or 2 to 5 their time. Okay. Now, a lot of times banks, asset managers may be in a whole different time zone than what the bank is at, but that's okay. Just try to get a guide and you can call a little bit later. 2 to 5 p.m. you make more phone calls and to get people, especially on like Thursday afternoons at 4:30, 5 o'clock, you don't get a lot of good people. Okay. And expect to leave a lot of voice messages. Hi, my name is Scott Carson with WeCloseNotes.com. I'm a note buyer. I'm looking to find the right person in charge of your bank's non-performing note sales. I believe it's you, John Smith. I'd love to talk with you, see what you have in your books this quarter that you're looking to move, to get rid of. We buy in most of the major markets and would love to take an opportunity, take a look at what you have and give you and have the opportunity to give you a bid back. We're buying for our own portfolio and we're primarily trying to work it out with the homeowners if possible. If not, then we'll go the route to foreclose. All right. Speak clearly, slowly. Don't call when you have a cold, like I do right now. And repeat your phone number twice. Slowly. Smile when you dial. Okay. Don't call in a bad mood. Don't mumble into your phone. Speak clearly. If you've got a thick accent, hire somebody to dial for you. Okay. It's not that difficult a question, not that difficult assignment. You just got to find the time to do it. You just got to reach out, everybody. Okay. But you got to expect to make 50 phone calls. Don't call me when you I made 10 phone calls and I gave up. No. Our average is making about 50 phone calls a day when we do our call blitzes. Don't do that much now. But on the email blast, 50 phone calls, 14 people you talk to, you probably get 4 non-disclosure signed, and then one deal. One deal could be an individual asset. It could be a tape of 1,000. Okay. 50, 14, 4, and 1. Gamify it. Okay. When I first started calling banks, my first day of calling, I made 54 phone calls. My last phone call, I almost didn't do because of getting frustrated, but I did. It resulted in a $5 million portfolio that I made a point off. I made $50,000 off of getting a tape sent to me that I split 5 ways to get it done. Okay. But that made every no I got along the way worth just about $1,000. When I got into Capital One, it took me 70 phone calls over 3 weeks to get to the right person at Capital One, but I knew that they sold their notes. The first note we bought off of there, we sold for $35,000 a wholesale fee. 35,000 divided by 70 phone calls is $500 for every note. Okay. And that was $1 million relationship that we still have with Capital One to this day. Okay. So understand that it's all in the fault. All in the fault. 80% of sales comes after the 5th contact. So that's why we tell you, hey, reach out and pull a list, drop an email blast out to them, follow up with those people on LinkedIn if you can find them, and then thirdly, follow up with a phone call. And then rinse and repeat every month. Okay. Follow up, follow up, follow up. Send an email, make phone calls, connect on LinkedIn, and do it again. Repeat, repeat, repeat. All right. 80% of sales are made after the 5th contact. Okay. Now, if you go through our 3-day class, we'll show you how to pull a big list like 2,000 asset managers. Are you going to call 2,000 asset managers in a day? No, but you're going to send an email blast out to them. A 20% open rate on 5,000 is 1,000 people. Okay, you break that up, 100 people. You make 50 phone calls a day. You follow up the next day. You call 50 more. It's just that process of slicing it down for a while. You don't need 100 sources. It's nice if you have 100 sources that send you stuff, but honestly, you guys really need 5 to 10 sources that send you stuff on a regular basis. It's going to keep you fed, fat, and happy, make more money than you've ever made anywhere else. Okay. And like I said, if you talk to somebody, put them on a hot list. So you don't have to send the same marketing blast to them. You can send a shorter email. Hey, Jim, it was great talking to you. Hey, Andrew, it was great talking to you last week. What do you have that you're looking to get rid of this next month? Okay. And we've done calling asset manager blitzes. You can actually go to this video here, bit.ly/calling asset managers, and watch me make phone calls for 4 to 5 hours and see how it's done. It's not as intimidating as you think it is to be. Here's the thing, ladies and gentlemen. If you are scared of your own shadow, if you will not network, if you will not pick up the phone, you will not send an email out to folks, go do something else. All right. We get people that are scared of their shadow, and I don't understand it. Get out and network. This is networking. Okay. Go to your local real estate club, go to local meetings. That's a great way to find and raise capital. It's also a great way to just start getting the word out to find note buyers or people to fund your deals. Pick up the phone and call somebody. But it's also important when you send an email out, make sure your email looks professional. Make sure it's not formatted incorrectly. Make sure you passed 12th grade English. Okay. You got to start developing little skills of marketing, making sure your LinkedIn profile, make sure you have a LinkedIn profile and it looks good. There's people out there that put crappy photos of themselves. They don't have a photo, they don't have any information. They're not sharing anything on LinkedIn. So that's the first smell test. When a bar or a banker is reaching out to me, I can see that they're looking at my profile to see if I actually pass the smell test. When we get phone calls and people that reach out to us, like, okay, you look like you're legit. Let's talk about, see what we have if you are interested in buying. Okay. Our upcoming workshop, like I said, our 3-day workshop, notebuyingfordummies.com. It's 3 days, the first full day. Okay. First full day from 9 to 5, 9 to 4 is all about finding deals. We show you how to find deals from banks. We show you how to get these lists in. We show you more specific. We give you the scripts. We give you the sample emails to follow. Okay. The post to LinkedIn to reach out to people. That's all included. We also on day 2 is all about the funding, the raising the capital, the marketing side. Day 3 on Sunday is all about the flip, exit strategies, structuring the deals properly, due diligence, and we'll be breaking down tapes and assets along the way. So check it out. Get signed up today. Notebuyingfordummies.com. It's usually $9.97. We're still running a $500 discount off of that for $497 for you plus a partner. So get signed up for that today. All right. And then we also have our monthly membership. It's $97 a month. Sign up for that for 6 months. It gives you access to the class. It gives you access to our online training, past classes, past workshops, access to tapes that come in. That's $97 a month. It's the biggest bang for the buck at noteumbrella.com as well. Get signed up for that today as well. All right. All right. Let's take a quick 5-minute break, everybody. We'll be right back. Okay. All right, let's get started here on session 5, markets and pricing. Now, let's talk about market expectations here. Note markets can vary based on a variety of different factors. It can be on the popularity, like Miami, Florida is a lot more popular than Miami of Ohio. No offense to anybody in Miami, Ohio, but it's a little bit more expensive in Florida versus what we see in Ohio. Market values obviously change. There's, like Ohio is a much more bang for your buck market, all right, than say Austin, Texas. Okay. You can pay more for stuff here in Austin, Texas, not only just because it's a faster foreclosure state, but also because the market values are a lot higher here, about double, if not, if I'm correct, sometimes triple. Same thing with foreclosure timeframes. Georgia, Texas, North Carolina, Virginia, Michigan all have faster foreclosure timeframes, which means the values are a little bit more than, say, a Florida and Illinois, South Carolina, which can take you about a year or so to foreclose on. And of course, populations, as you're starting off, I say stay in the larger populations, 50,000 people at a minimum in a city. Okay. Not like I give you an example. If you're on the outskirts of a major city, like I give you an example, like Belton is north of us here. There's less than 50,000 in Belton. But it's about an hour from Austin, and it's a desirable area right off of I-35. Okay. I'd buy in Belton all day long, even so it's less smaller. I grew up in a South Texas town, a little small town called Ingleside. Only about 10,000 people in Ingleside. I wouldn't necessarily buy in Ingleside if I was brand new, but I would buy there because I know that market and I know what's going on. So it all comes down to how much you're familiar with the market in a lot of cases. Okay. I wouldn't buy out in the middle, like a mobile home on the outskirts of town. I avoid rural properties unless you're looking for a plot of land with a mobile home on it. It's a different story. You know what I mean? But for the most part, when you're starting off, stick to the bigger cities, the bigger markets. 50,000 people or more gives you buyers, gives you realtors, gives you vendors that can help you with your stuff. Okay. And you start getting into those outskirts, small little outskirts towns, unless they're right on the outside of a major city, don't waste your time buying real. Move on. There's plenty of inventory coming. Okay. Plenty of inventory in different states out there, as we mentioned out there. Like I said, Florida's got a lot of stuff. Texas has some increased stuff. Ohio, Michigan, Indiana. If I was starting off, this is what I would focus on my top 3 to 5 states. Indiana, Ohio, Michigan. 2 of those are judicial and one's non-judicial. Okay. I like Texas, but I don't count my top 5. If I see anything here, it's the cherry on top of the banana split. Okay. North Carolina, South Carolina. North Carolina is a non-judicial. South Carolina is a judicial. It'll take you a year. But the great thing, ladies and gentlemen, you're going to have a variety of inventory. Missouri is non-judicial. Kansas is judicial. Okay. Those are great states to buy in. Okay. I'm looking at 5 assets in Oklahoma right now. Great little assets that I can pick up and about a 20% return if I foreclose. If I don't foreclose and I have to go in and clean them up and sell them as an REO, my ROI goes through the roof. Okay. So keep that in mind. All right. Now, what's hot right now? Like the most expensive note markets are always going to be California. All right. Arizona's hot. More expensive because of the property values out there. Although Arizona is in a bit of a dip right now because of the mass amount of more foreclosure we're seeing there. Texas is always hot. Doesn't matter what it is. Texas is hot here because of our faster foreclosure process. Although they will say that some of the markets are in a decline. No, it's more of a correction. Here in Austin, yeah, we're not as high we were a year ago. We've had a small dip. It's not a crash. It's a 5% dip. It's more of a correction, especially here in Austin. But Dallas, Houston, San Antonio, all strong markets, okay? Nevada, Sin City, Las Vegas is demand for that stuff. Georgia's a very fast foreclosure state, but you've got that tricky issue with Georgia needing to be a mortgage broker's license or fund with your self-directed IRA. But Georgia's a good market to buy. People are looking for stuff. And then anything on the West Coast people want. I don't buy in Oregon or Washington State because it's trickier up there. They're not landlord or lender friendly, and you need to have a specific license up there as well. Debt collector's license. Not worth my time for the headaches. Okay. What's not hot is the least favorite markets are your New York, which takes 3 years to foreclose. New Jersey can take you 2 years to foreclose. Those are not tenant friendly states. Kentucky has lower values than those stuff, and it also requires a bond, personal bond of $500,000 or corporate bond of $1 million to buy debt in Kentucky. So I don't buy there. Illinois is not a bad state except for Chicago and Cook County. I just avoid it like the plague. I've lost money there. It's a pain in the ass. Now, if you live there, different story. If you live there and you're a voter there, great. But if you're outside the state, it's such a corrupt environment, don't do it. And then don't buy assets that are under 30,000. A few years back, 10 years ago, $30,000 assets you could make some money on. These days it's really hard to make that low balance stuff work unless it's just unless you're getting like for pennies on the dollar. Okay. It's not the same pricing. Those lower valued assets, I'll give you an example. Sterling, my coach's student, he's buying a house is worth like 55, 60, borrows like 17, 12 or I want to say 17 is maybe it's 13, but he's buying it for like 4. Okay. Or no, he's buying it for like 8 because it's going to return like $4,000 a year. So that he's comfortable with that. If he forecloses, he'll make a little bit of money. He's not going to retire on it, but he likes the asset, the cash flow process for it. So that's something to keep in mind. Okay. We usually tell people, like, when you're looking at a tape, start getting rid of the low balances, like anything really below $25,000 balances, below $25,000 in value, just get rid of them because it's not worth your time compared to what you would put into another larger asset. Okay. Also, high equity deals. Like if they only owe 100 and the house is worth like 300, the banks are going to want you to pay 80, 90 cents of the dollar of that 100,000. Doesn't make a lot of sense for you to then go through the foreclosure process and basically break even. Now, it's hit or miss if it'll sell at the auction, but if you got a ton of equity, it's probably going to sell at the auction and you're not going to end up with it anyway. So you did all this work for a very small profit, not worth it. All right. Like I said, where's the most inventory now? If I was starting off, I would focus on Ohio, Michigan, Indiana, like I say, Illinois outside of Cook County, Missouri, Florida has some stuff. You got to be very careful about Florida with the condos, the HOAs, and insurance costs, Florida. But if you're down there and you're okay with that, then you're good. We're also seeing an increased amount of reverse mortgages where people are passing away, and where we didn't see a lot of this beforehand, we're seeing a lot more reverse mortgages coming to the market. Okay. And like I said, small balance commercial, really that sub $5 million in value. There's a lot of opportunity out there that the big boys in Wall Street do not want to waste your time with anything on that low, small balance. But if you know the area, know location, and know what you can do with that property and think you can do it, by all means, go get it done. Okay. Now, pricing models will vary. If it's non-performing notes where they're underwater with negative equity, we use a stair-step method. I'll go through that in a second. Especially, here's the thing. A lot of sellers are going to tell you highest and best. They're not going to go price each asset individually in a lot of cases. They're going to give you your highest and best. If they don't give you a specific number or reserve pricing, as we call it, then you got to figure out your best pricing. And that's what we'll go through the stair step. Now, if there's equity, non-performing equity, like I said, the bank is going to want 80 to 95% of the unpaid principal balance or the legal balance, depending on what it is. Okay. So if there's equity, you're looking through your spreadsheet, you see the payoff and see that there's the market value is quite above. It's pretty easy to run a formula for 80 cents on the dollar and then looking at what your numbers would be cash flow wise. Contract for deeds they're varied. Sometimes they're performing, non-performing, but 30 to 60% of either UPB or fair market value in a lot of cases what I look at buying contract for deeds. Junior liens, like I said, seconds are way overpriced. There's not a lot of inventory. I get so many people, I want seconds. Well, great. There's not a lot out there. Go focus on first. Okay. Like I said, commercial, multifamilies, apartments, self-storage, mixed use. It completely varies by cap rates and asset class. Okay. You're going to submit your bid as a percentage of the UPB or the legal minus taxes. Always check taxes owed. That's one of the big things. Call in the county, see what's owed in back taxes. Let's see here. Abu Katu 7 says he's looking at South Boston. Oh, you're from South Boston, Massachusetts. Nice, very nice. We see some stuff in Massachusetts from time to time. Can be a relatively fast foreclosure process up in Boston. Just gotta be careful in the neighborhoods like you would in any other parts of the country. Like Tennessee, I would avoid Memphis because that's a street by street aspect of things. So just be careful. If you have any questions, feel free to reach out to me. Glad to tell you what you should probably make an offer at, where if it's going to make sense and go through you. All right. Now, stair step is the reason we call it the stair step pricing is it looks like a stair step. Okay. Now, this is where there's negative equity, where they're underwater. They owe more than the property's worth. So The lower value on this would be the lower number would be the value of the property. We as investors look at the value of the property, right? So on the low side, if it's under $30,000 fair market value, you're not going to offer more than 25%. So like 30,000, 25% of that is 7,500. Okay. There's taxes owed, take the taxes off. If it's going to almost a foreclosure, you probably have to go up a little bit, but I would stick to that number. If it's in the 30 range, 30 to 39, 35% of fair market value. If it's in the 40K range, 40 to 45%. If it's in the 50K range, 50 to 60, 55%, and then 60 and above, you probably, if it's a one-off asset you're buying, okay, you probably need to be in that 60, 65 range, sometimes below. Just depends on the condition of the property. The great thing, ladies and gentlemen, don't do a lot of upfront due diligence until your offer is accepted. It's very acceptable that the sellers were going to use a Zillow estimate, a Zestimate, or an AVM, which stands for Automated Valuation Model. Basically, just looking at online values real fast to get a rough idea. If your offer is accepted, then you're going to have time to actually pull value, pull comps, go get a broker price opinion, look at the true value of the property. And if your value comes in way below or below what they say, you can reduce or fade your bid. You're just going to have to provide proof that the values are below. Okay. So I'm a big fan of making offers, winning the bids, and then fading them down as we get into our due diligence. Okay. Doesn't take, if they've got a Zillow value, something they've pulled in the last 6 months or whatever, that's what they're going to guide their pricing off of initially. And then you can get in and haggle them during your due diligence. If you sit there and haggle them on the front end, it's a bit lowball bids because their values are off. They're just not going to accept your offers. Win the offer and then fade during due diligence. Okay. And I actually prefer to chase occupied assets, not vacant assets. Remember, I got to have that banker's mindset. So I got to have somebody in that property to pay the mortgage. If they're dead or it's vacant, nobody's going to pay the mortgage. Then my really only strategy is to hopefully get a cash for keys or deed in lieu, a foreclosure or foreclose, which can take longer. Okay. But if there's occupied assets, they're usually in better shape. Somebody's taking care of them. That's not saying you won't need to replace carpet. It doesn't mean you're not going to put new appliances or put paint on. You probably will have to do that if you take the property back. But the air conditioner's there, the electrical there, the plumbing's working usually. It's heated during the winters. It's in better shape. There's more exit strategies to get the bar back on track, the payment plans, cash for keys, deed in lieu, a loan assumption, a payoff versus just a foreclose. Like I said, if it's occupied, they're easy to reinstate or modify. They're easier to do a deed in lieu, a foreclosure, or cash for keys. There's emotional link with the borrower may have kids or have lived in the house for 10, 15 years. They don't want to lose it, so they're willing to work with you. There's also less capital expenditures when it's owner occupied. So if you end up an occupied asset, like I said, basic things are being taken care of. You're going to have to do some, paint and carpet most of the time, but for the most part, you never even have to doing that because you just buy the note and you get the bar back on track. So there's no rehab, no foreclosure costs. Okay. Questions before moving on to different funding options for notes? All right. So our next session here is about funding options. How do we buy a note? All right. Can I go get a mortgage to buy a mortgage? No, it doesn't work that way. Okay. How do you pay for a note? Well, you're going to be sending a wire transfer into the bank directly or the seller directly. You're not going to be sending a check. All right. You can use your business line of credit if you have, or a personal line of credit to pull money off of your account and wire the money to do that, but make sure you're making good money on the deal. I would check out, if you're interested in getting lines of credit, check with getfundable.com. That's Merrill Chandler and his team at Get Fundable. Phenomenal people over there and helping us get lines of credit, helping you get your credit where it's fundable in a lot of cases. All right. They help our students with lines of credit, personal business. Helped literally alone taking what they do, their class, their knowledge has helped save me thousands and thousands of thousands and thousands of dollars. Or also help us get thousands and thousands and thousands of dollars in lines of credit as well too for us. He's got a boot camp he does for 2 days. Basically, go to getfundablebootcamp.com, check it out. But most of the time, you're going to use other people's money if you're not using your own funds. Okay, using IRAs, other people's savings. You're going to have that wire to an escrow account and then wire that into the bank to fund it. All right. Now, self-directed IRAs, you can use Roth, traditional, anything that's self-directed. You can use solo 401k to fund your deals, a SEP IRA. You can also use self-directed HSA. You can also use educational IRAs, like cover deals. It's not 2,000 a year for your educational IRAs for your kids, but you can combine those together and fund deals with those. Okay. Our preferred IRA custodian is American IRA out of North Carolina. Great company, easy to deal with. And you can see that the increases of the amounts have increased over the years. So, like, you can put up to 7,000 into an IRA. Gives you an extra 1,000, another 1,000 if you're 50 or older. 401ks has increased a little bit as an employee to 23.5 or 70,000 total. Okay. HSAs increased by $150. Is not that much for an individual, or they went up by $250 for a family. Solo 401ks, it went up by $500, and then the SEP IRAs, it went up by 1,000. So you can really sock away a lot of profits into your IRAs if you're making money, and whether it's Roth or traditional can change the way it's taxed. Okay. Now, the question I always get, well, how do you secure a note if you can't get a mortgage to buy a mortgage, right? Well, what happens when a note is sold, it goes from one bank to another bank, basically, one lender to another lender. It's called an assignment of mortgage. So there's a collateral file that you're buying. This is actually what you are buying. This collateral file, this loan file is actually what you're buying. Okay. You do a collateral assignment where the funder, whoever your private investor is, they hold that until everything's done. Okay. Or they hold your collateral on other notes to provide basically collateral and protects their investment. Okay. You could also file UCC1 in the county that it's in against, they could file UCC1 against you, which is fine. Basically, it's like a lien against all your assets for that LC. A lot of people do what's called a co-assignment. So if I'm buying from ABC Bank and I have John Smith, my funding partner, it'll say, ABC Bank assigns to 50% interest to Inverse Asset Fund and 50% interest to John Smith IRA. Okay. That's one way to do it. If you've got other property that's got equity, they go slap a lien against those properties to securitize their investment. You can also pay for a loan by selling partials off your other existing portfolio of performing notes to pay for it. All right. If you're going to bring in money, and I always say if an investor is going to bring in a chunk of change like 250K or more, we'll start an LLC with them, and I'll own 51% of the LLC. They'll own 49. They'll fund the LLC, and that LLC will buy the notes. It's a special purpose LLC. What you cannot do is you cannot pool money. All right. If you don't have a syndication or PPM put in place. Okay. You don't want to take 25 grand, 10 grand here, 5 grand, $500 here and pool that together. That's illegal. All right. You only want to have one investor per one note. Now, one investor can fund multiple notes, but when it comes to buying a note, the most you could do would be you plus another investor funding the deal. Okay. Partnering with the deal on it. Okay. Or you could sell off your LLC. You could sell shares off, and they're funding the LLC by buying shares in your LLC, and that LLC is going and buying notes. Okay. Will a bank give me a note loan? No, they will not. Banks will not lend on notes. Smaller banks may do collateral assignment, where they will hold. They'll basically give you a loan as long as I'll give you an example. A lot of hard money lenders will go make a loan for 200,000. Hard money loan, use their own funds, and they'll go back to their bank, and the bank will give them a collateral assignment, say for 100 grand, hold the collateral on that first note, and give them 100 grand to go out and do more on the second mortgage or a second note to another hard money borrower. Okay. It uses about 50% of the UPB of the loans that they create. Okay. Some banks will do assignments, or they'll joint venture on commercial notes. Like, okay, if you want us to partner with you, tell us how you want to partner. Like the Synovus Bank out of Tennessee and Georgia, they'll do this on their loan sale agreement. And that's where they'll, okay, we'll sell you the note. You're taking over the asset, taking over basically the operation of the asset. This usually happens when you're going to foreclose. We'll give you the money. We'll give you 80% of the purchase price of the note. You bring 20% of it down, and we'll finance the other 80. But usually it's only on commercial assets $1 million or more. And you've got to usually have a team or experience in handling that asset class to make it work. Okay. But getting 100% financing or 80% financing on your note purchase is a lot better. The reason the banks would do this in the commercials, they don't want to lose that $1 million asset, basically. Okay. Um, Hard money lenders will not lend on notes. They don't want to be in a 30-year mortgage. Hard money lenders like to be in 6 and 12-month loans because they're rinse and repeating. They're making the points on the origination points, and they're also making a spread between what they're borrowing the money from an investor at 8% and what they're making the loan at 12 to 14. So they don't want to give a loan out to be longer around than 6 to 12 months. Okay. Now there are some lenders we've used for just a year. A couple guys that we've used worked with that gave us 85% LTV. So we funded 85% of the purchase of the note, brought 15% down, and after a year we refinanced them out because we went through the foreclosure. Okay. They like short-term loans, 6 to 12 months. They like to control the asset, obviously. They make their money on their points in the churn. Now you can often buy hard money notes directly from hard money lenders at usually par, full value. Hard money loans are usually will be written at like 65, 70 cents on the dollar, right? They have higher interest rates, 12% or greater. It's great if you have cheap funds, and they're usually kind of a faster turnaround time. Now, when you fund a note, you put a little bit more on there. And this is one thing to keep in mind when you're buying, making sure you're not overpaying for the asset. So there's things that you want to add in, like we'll look and see if there's property taxes. We'll add that amount into the funding amount. We'll add a little bit of money for our due diligence, getting a $500 per asset for due diligence. That's going to cover our O&E title report and cover getting a BPO out there. Somebody in a realtor ought to pull a real value. That's $500 roughly. I mean, usually less than that, but we'll add that into the funding amount with our investors so we get reimbursed for that. You always want to put eyes on the asset before closing. No, that doesn't mean jump into Southwest Airlines plane and fly out and look at every asset you're bidding on. You can use Zillow and some of those stuff, or use BPO agents to go out and take pictures. This is why we always put eyes on the asset, either with the agents or like if you're going to buy in one area, like we're looking at these 5 in Oklahoma City. I may drive up to Oklahoma, take a look at these 5. That would make sense to do that, but I wouldn't do it. You're in Boston, you're buying something in Arizona, send out a BPO agent to do it. So it saves you a lot of time. It costs you like 130 to maybe $200 if it's a little bit rural. Budget in your foreclosure costs, your taxes, your workout servicing costs. So we always will say, $2,500 on a non-judicial foreclosure for workout costs, $1,500 for servicing. And so that's kind of what we figure plus taxes. So we're going to be budgeting in $4,000 to $6,000 most of the time, unless it's in a longer foreclosure state. So buying the note, adding taxes if taxes are due, and then 46 grand in workout costs. Okay. Some repair costs, they're kind of a wash, especially if we're buying it at a big discount. I don't start budgeting repair costs unless we know we're going to foreclose and take the asset back. But I will also, sometimes we'll have them fund it. Other times we won't. It just all depends what you're buying that note for. Okay. You always got to figure out forced place insurance too. You need to cover your ass in case of a natural disaster, and that varies state by state. Okay. There's also going to be little other miscellaneous fees like the utility, water, gas, HOA fees, code enforcement liens that may not go away. Got to figure that's why we pull a title report before closing, so we see what kind of liens are on there that are not going to get wiped out in a foreclosure. And like we said, we may throw in an extra $500 to $1,000 just for miscellaneous marketing costs or an asset management fee, just because you're going to run costs like email, internet, tracking. There's things you're going to track along the way that, to market your assets, your email, your website, throw those in there to reimburse you for those stuff. Okay. All in all, you really want to believe if you're buying a note that's underwater where they owe more than it's worth, you really want to stay below 65% as is when you throw these things in. Okay. If you're buying a asset with equity, your repair costs, stuff like that, aren't going to come into play unless you take the asset back. So being at 80 cents of the dollar legal balance, that gives you a 20% cushion that if you sell it at auction, you're still going to make a nice chunk of change. Versus then if you do foreclose and take it back, then I would go back to your investor and say, hey, I'm going to need the 25 or 30 grand more to rehab the property. Or keep them in mind. I only need this much now to foreclose. If we do foreclose and don't sell, then I'm going to need a little bit extra money to go in the repair. Okay. The thing you always want to tell your investor, there's 5 things that are protecting your investor. One is that you're only buying first liens, right? You're in the driver's seat. The only thing you might be able to be God and taxes. You're going to pay your taxes. and you're going to pay fourth place insurance in case of an act of God. You're buying below 70% of as is value, so you're always got that cushion. You're going to use a servicing company and attorneys to collect and foreclose on. You're putting fourth place insurance down in case of an act of God, obviously. All right. And you're always going to check title and collateral files and have somebody drive by the property. Okay. Making sure that they're protected. Those are the 5 things protecting your investor. It's not me pulling title. It's not me reviewing the collateral files. We're going to have somebody professional do that. We're always going to buy it 70% below. We're going to have servicing companies. We're paying servicing companies to have the collections. If they're unable to collect, then we're going to hire an attorney in that state to foreclose. And then we're putting insurance on. So that's the 5 things to keep in mind. All right. Questions before moving on to finding investors? All right, let's dive into finding investors. This is one of our favorite sessions. I guarantee a lot of folks always have questions about raising capital, and this is the ways that we find investors. Okay. So you're going to need investment money at some point. I don't care if you've got 100 grand or 200 grand, unless you got 10 or 15 million in the sidelines, you need to worry about raising capital. Okay. And if you got 10 or 15 million sitting on the sideline, it's pretty easy to raise capital when you've got that. But when you're starting off, you're going to go attend real estate investment clubs, meetup groups, and go do this. If you don't go network with people, you're not going to be able to do this business. Okay. You have to realize that you have to get out and network. Okay. Go on LinkedIn and network on there. Go post things on LinkedIn. Go add connections as well. All right. You can look for keywords, note investing, note investor, real estate. Go in some different LinkedIn groups. You can look at different profiles of people and start connecting with people. You can go to Connected Investor or Bigger Pockets and connect with people on there and raise capital there. We'll show you how to do that in our 3-day workshop by tracking keywords or what people say, and then send them a pitch deck video. What's a pitch deck video? Attend our 3-day workshop and you'll find out how easy it is to put a pitch deck together. Okay. Or if you're in an area where there's self-directed IRA custodians or trustees having events, go to those, go network. That's a great environment to go and meet other investors. Right. Now, we also use public records to find investors. You can go to Netra Online, NETR Online. It's a free website that basically pulls all the different county records of all the states. You go to Netra Online, it'll pull a map of the United States. You click on a state, you pick the county, and it gives you the list of counties and their corresponding websites. Okay. It's a free tool for appraisal districts, which we use these to find investors, and county clerk or recorder's office to track investors. Okay. We like to use Netra Online to find people, investors who've used their self-directed IRA to lend or to buy a property. Okay. Because if they're using their self-directed IRA, it's got to be passive. They're investors like you and me, and they're looking for deals. Okay. And we'll do a search by the 30, 40, 50 different self-directed IRA custodians that are available out there. Now, the appraisal districts, when we go to appraisal districts, you search by an address or you search by a name to see what a person owes in a county, right? Well, in most counties, same thing. If I go there and do a search for like Equity Trust or Quest Trust in the property owner spot, it'll pull up everybody that's used their IRA at Equity Trust to buy a property in the county. And guess what? It'll give me their mailing address. That's a great list to send out postcards or mail campaigns to. All right. And that's the only direct mail we do, but it's to a very rich, high, a very efficient list of high valued contacts to send to. Okay. We'll find that if it just gives us the IRA number or it doesn't give the full name, you can search by Spokio or White Pages to find their names, people that live there. Or we'll just send into, hey, Equity Trust client. Okay. It'll show us that if they own their own home or they have multiple properties, these are great, great ways to find investors to fund your deals. Okay. And then rinse and repeat. Okay. Mail, letter, postcard, follow up with them. If we find their name, connect with them on social media and contact them directly there. Now, the recorder, the county clerk's office, will be doing what's called a deed search. Okay, same thing. Equity, a deed search for equity trust, Quest Trust, whoever it might be. Same thing, gives us a lender, shows us who the lender is and who the borrower was. Okay. And it gives us a mailing address for the lender. And what do? It also will send a letter to them, but we also know how much they lent out of their IRA to the borrower. So it gives us two contacts. Same thing, mail, letter, postcard, contact the social media. We'll do also a release of lien as well. And that will give us people who have gotten their money back from their IRA, and just rinse and repeat it. Doesn't cost you anything. Now, not every county will let you search by borrower name or generic name. All right. You have like states like Maryland, Virginia, privacy laws, California, Arizona, and Nevada won't let you search, and Minnesota won't let you search by name, and that's fine. Just go and you can buy a list from different places for that. Okay. But for the most part, like if I go into Ohio, I can search in the biggest counties there and find, 1,000 IRA investors. I can go to Texas and search and find 2,500 people in the top 12 counties. Okay. But you can buy a custom list. You can pull a list of IRA owners. They may not be a specific like self-directed IRA in real estate or notes, but they're going to have a generic IRA. Okay. You can also filter it by people that have 150K or more in their IRA, but do it by city, state, or county. You also purchase a list of employees with a company. So if they've got, like a Tesla or a Microsoft, buy a list of contacts there. It'll be pretty rich. And it'll include name, address, email, and sometimes a phone. We use Melissa data or exact data to buy those lists. Okay. It's going to cost you 6 to 14 cents per lead, or business 25 cents per lead, but you're going to buy an order of a minimum order is usually going to be about $1,000. So it's going to give you a big list. And this is why it's important to have like an email CRM set up, because if you buy a list of leads, it may be too big for you to market out to. So one of the things that we offer up is that we'll buy the lists and then sell you a smaller portion of the list. If you want 500 people, okay, we'll sell you that, but it's gonna be $1 a lead, because we got to go out and buy the big list, right? So we can give you a better deal and something you can actually use to get rock and roll. 500,000 at a time is easier to digest than trying to put 16,000, which would be a waste of time. Most people never get to. Okay. Now you can post as well about what past deals you've done. Case studies are a great way to raise capital. Post deals from past experience, post deals from others. Case studies, these are types of deals that we do. Here's a deal that we did, or here's a deal that one of my friends did. Post deals you're working on. Hey, we're looking at this tape of 40 notes right now, or 100 notes. Never ever mention safe or guaranteed in your posting. I don't get in and say, hey, we'll talk about making an above average return, but we say I'll make a 16% return. We don't do that. Okay. You want to create a 10-minute pitch deck video. It talks about you, what you're focused on, and some case studies of what you're doing. That's a great way to answer a lot of questions at once, but it also is a bit of professionalism that most people won't do. All right. And your pitch deck is about you, your focus, your company and team, your vendors that you use, and then the types of deals that you're doing. Pretty simple to do. But when it comes to dealing with IRA investors, you got to make sure you qualify, make sure they're a good fit for you and your business. Okay. Are they currently investing in real estate? If they've never invested in real estate, they're probably not a fit. Okay. Are they accredited or sophisticated? Meaning, do they make a specific amount of money that allows you to market to them? How much are they looking to invest? 50, minimum is 50K in a lot of cases. I'll do 25K for friends and family, but 50K really needs to be the minimum amount that they're investing. If it's below that, they're not worth focused on. You got to ask this question: how much are you looking to put to work? If you're dealing with somebody and they say, oh, I want to invest with you, but they only got $5,000, and you don't ask that question, it's not their fault. It's your fault for not asking the question. And how long are they looking to invest? We're not talking 30 years. And when you start talking about notes, people think, oh, I got to be tied up for 30 years. No, no, no. We're buying non-performing, get it reperforming, and we're going to keep it for cash flow, sell it off. Our deals are 24 to 36 months. Okay. Are they active or passive? Now, if they're an active real estate investor, they may not get excited about 8%. They may want 12. If they haven't done anything in the last year, don't give them a 12%, give them an 8%. And find out what kind of returns they're looking for. I had one guy say, oh, I got $500,000, I'm willing to invest with it. Okay, what kind of return? I want 15%. I'm like, then go do it yourself. I don't want your money. It's too expensive. I can go out and get better returns if I just market a little bit. Okay. And we use an investment questionnaire to help them qualify. And we make everybody fill that out. It's important to make everybody fill that out. And we go through that in our class. Okay. There are some investors you want to avoid. People unfamiliar with real estate, don't understand real estate investing, never invest in real estate, not a good path. People wanting short-term or higher ROIs, like, oh, I want to be out for 90 days. Well, it's not a fit. Okay. Like I said, investments below 50,000, not a really good point. People who talk bad about others, look at what they do in their socials. I mean, well, you can see everybody who's crazy right now talking bad about Trump and everything like that. If just imagine if it's a deal and your deal's dragging out, they're going to talk bad about you. So avoid those folks. One of the things we asked during our investment questionnaire is, have you sued anybody before? And we want to, you want to avoid people that are just going to sue you at the drop of a hat. And when you're talking with investors, it's just as much about you interviewing them as it is about them interviewing you. Okay. So who have you worked with? Who's your attorney? Who's your accountant? Who do you use for that kind of stuff? Okay. Who have you worked with in the past that I can reach out to, make sure it was a good fit? And that's the thing. If somebody comes to me and says, oh, I got $500,000. So why don't we start off with $100,000, make sure you're a fit before we dive into bed together. Because you're going to be kind of in bed with these people for 12, 24, 36 months. So keep that in mind. But you always want to require your investors to fill out the investor questionnaire, profiler questionnaire, send you an email with a pledge letter. Basically, it says, hey, Scott, I love talking with you. I've attached my proof of funds statement from my IRA, and I'm pledging 50K or 100K out of that balance toward note deals with you. If they won't return these 3 items, they're not going to fund, so don't waste your time, okay? The reason you want also to fill out the investment questionnaire is find out where the funds are coming from. So it's from their retirement account. Well, who is that with? That with like Quest or Equity Trust, or is it with like a Schwab, an AG Edwards, or Chase? So with Chase or AG Edwards, they're going to have to move that over and open a self-directed IRA account with a trustee. So you got to follow up with them on that. And here's the thing: you can't wait till the last minute. If you got a fund on Friday, that's going to be Friday. You're talking on Monday. It takes 3 days minimum for them to to transfer the money out of funds, mutual funds, stocks, bonds into cash. And then to wire that to a new IRA account is going to take another couple of days. So you're talking money may not show up till Thursday or Friday. So you want to really give yourself like a 2-week advance for them to get the stuff done. All right. This is important. No matter if you're borrowing money from your uncle, your mom, create the paperwork just so it's done. It outlines what's going to happen, start to finish, have it created by an attorney so it's official. We always allow investors, CPAs, or attorneys to review the documents, and if they want to tweak a few things. The thing I always ask when somebody comes back, oh, I want my attorney review. Right. Has your attorney done real estate before? If they haven't done real estate before, that's like going to your attorney for them to give you an opinion on your brain tumor if you've got one. It doesn't make sense. Okay. Always use agreements. It outlines when things go wrong. Most investors cannot make 6% or greater right now, unfortunately. They're not pulling the trigger, so don't give them 6% or greater. Okay. If they're making zero, if that money's been sitting in an IRA account, not making anything for a period of time, 6% is an above average return. So that's why it comes down. What's it invested in? How much has that money been working? What have you bought in the past? What have you bought recently? How's that worked out for you? And asking questions and going from there. Now, when it comes to payments, if making payments, make quarterly payments. If it's a performing note, avoid monthly. If it's a non-performing note, don't make payments until it becomes performing or you sell the asset off. You can do an online portal like Basecamp for tracking. There's a whole variety of different things to share docs to go from there. Never pool investors' money together. One investor per asset, as I said before. Trust your instincts and go from there. Okay. Questions before we move on to marketing tactics? All right, let's move on. All right. So when it comes to your note business and becoming a note investor, you are going to have to up your marketing skills a little bit. Not difficult. Anybody can do this. You just got to be willing to grow. Got to learn. Okay. And when I say that 80% of sales are made after the 5th contact, that means you got to market more than one time, more than one phone call, more than one post to get people to pay attention to what you're doing, to either send you deals or to fund your deals. It all comes down to marketing. Okay. And you got to post. You got to have social media these days. Facebook is a dumpster fire. We know that, but it's still important to post there. There's groups, LinkedIn, whole variety of different places to post. Now, you can automate some of your marketing by using tools like buffer.com, Hootsuite, to schedule things if you're working full time. Okay. So you go in there and plan ahead 1 day a week and plan your post and what you're going to talk about and have it automated. Okay. There are 3 things that are really the most important things in today's market to leverage and learn about. Okay. As a real estate investor, these things will help you long term. One is sending out an email blast. Keep Black Book, REI Black Book are 2 of our trusted vendors. Okay. LinkedIn, you got to have a LinkedIn profile. You got to have an up-to-date. You got to post to LinkedIn on a pretty regular basis. People are looking there. Okay. And the third thing is video. Every social media platform has video. That's where everything is leaning towards. That's where all the platforms are pushing video. So you got to understand that. YouTube obviously is the number one. It's not only the number 1 video area, it's also the number 2 search engine. Okay. So we're not talking going out and creating hours and hour-long videos, stuff like that, but posting deals or case studies will help you raise capital, help people see that you're understanding. Okay. Now, email marketing is still the number 1 ROI for marketing. Still 44. You're going to make $44 for every dollar you spend on marketing, and you're going to use this weekly with your investors and marketing your warm database, and monthly with your asset managers. Okay. Whole variety of things on Tuesday, Thursday. We like to send out an email to our investor database at least once a week, sometimes Sunday nights, but usually sometimes Tuesday, Wednesday, or Thursday, sometimes multiple times. And what do I talk about on a weekly email? This scares a lot of people. Like, what can I talk about? Well, there's always a holiday. All right. So like right now we have Easter coming up, right? We had April Fools could be an email to talk about, right? We have Easter coming up next week. All right. That would be something to talk about. I already got an email this morning actually from a company saying, hey, happy holidays. And we're a week out, right? You could talk about upcoming meetup. If you're going to your local meetup group or networking event, something like that, or talk about that. Hey, most of us, our database initially is going to be pretty much local people. Or if you go to a conference, it's going to be a variety of different people from that conference. Just keep in mind what your database has. Okay. Hey, I'm going to a local meetup group. We're going to talk about rentals this week. Anybody interested in rentals? Learn about rentals, come on out, we'll buy a beer. Okay. We also have personal events, something fun going on once a month. Maybe it's a birthday, maybe it's a family holiday. All right. Maybe it's graduation in May, maybe it's starting a school. There's always something going on you can share about, past or previous event. Okay. Could also be something. People love case studies. The whole goal of marketing on a regular basis is not just to ask, hey, I need funding, which is what most people do, is they don't market till they need funding. And they've built no rapport with their audience. So the idea is to share something valuable. Just get them to start thinking about you once a week with something, and that way you've done it a couple of times. So when you do have a deal that needs funding, then you can say, hey, I'm working on this deal. I'm looking for funding partners. Anybody's interested. Okay. And like I said, I already talked about emailing our asset managers 1 to 2 times a month. Okay. LinkedIn, number 1 social media platform out there, bar none, for investors. Complete your profile 100%. Fill out the about you, talking about what you do. Turn it into like your mini executive summary in your about page. Post photos of assets. Post your resume. Don't go all the way back to you're in college as a barista, but post what you've done, your working career. Okay. Bankers are going to go here and look at it. Investors are going to go here and look at it. Okay. So it's an easy way to find them. It's also an easy way for them to find you. Okay. We like to automate our LinkedIn. We use Octopus CRM to help maximize our connections so we can connect with people 50 to 100 people a day. I'm sorry, 100 people a week. Now they changed up what you can do with Octopus, but that's okay. 100 people a week is still better than 0. Okay. Now, only 3% of LinkedIn users post on a daily basis. Keep that in mind. Okay. 3%. If you post on a regular basis and ask, like if you get a tape of 49 assets, there's potentially 49 properties to post about. Okay. Can I hire a VA to do that? There are some large real estate investing groups in LinkedIn to join and post to. Okay. And there also allows you, if you have a smaller database, it allows you to upload or import 1,000 contacts. So you can go out and find if that email that you uploaded is attached to a LinkedIn profile of a friend or family member. Okay. Now, video marketing, this is where people get scary. But guess what? If you've got a smartphone, you have probably the best camera that you will ever buy. It's a better HD camera than your Polaroid and your Nokia, whatever you're using, Canon. All right. Use it. Go out if you're walking a property, take a video. Okay. Like I said, YouTube is the second largest search engine owned by the number one search engine. If you're not using that, you are falling behind everybody else that is. Okay. Now, we'll film a video and post it to YouTube, but we'll also post it everywhere else: Twitter, Instagram, TikTok, Facebook. What else? There's a whole variety of things: Blue Sky Butterfly, or Blue Sky, or Lemonade, or Trump Social, whatever you're using. Post, post the video, Threads, post the video. That will draw eyes to it. But you also got to make sure and put a description on there, use a good keywords, and then also a good thumbnail. Sometimes the thumbnail is just going to be your face or the picture of the property. But this is going to be one of the most valuable tools if you'll spend some time working on it. You can make thousands of dollars with marketing and raising capital if you just embrace this a little bit. And they don't need to be long videos. Actually, short videos do really, really well. Now, live video works well on LinkedIn. It works well on YouTube. It works okay on Facebook Live. It only, if you post your video to Facebook, it's only going to stand around for about 24 to 48 hours. That's okay. But talking about case studies and what you're doing on LinkedIn, it's a great way to get the word out, to grow your audience and grow your network. Okay. And like I say, take pictures of your phones at least. If you're out looking at property, take a picture of the property and post it. Hey, I'm out walking this property this morning, or walking this property, or checking out the snow. Not hard to do. Okay. Now we have a thing called the marketing octagon, or the content spider, we've called it before, where we take one piece of content, one photo, and we share it across multiple platforms. Photos and stories do best. Right, to repeat, the reason you post to multiple platforms is not everybody sitting around waiting for Scott to post on Instagram or TikTok, right? You can use buffer.com to automatically share it across multiple platforms from one spot and pre-schedule it. Okay. The idea is to share it multiple times, so it's that multiple touch approach. I've actually had asset managers reach out to me from TikTok videos to buy notes. Never thought that would happen, but it works. It's effective. Okay. And the more you cross promote on a thing, a video or deal, you're going to have more hits, more engagement, more people reaching out to you. Okay. Best times to post are at lunch, 3 p.m., 7 p.m., and 9 p.m. We even started posting a short video every hour starting at 10 a.m. From 10 a.m. to 9 p.m. at night, we post a short little video. It may be one of our longer videos that are cut up, but we use a service called Opus Clip to create short clips. All right, so we can post a 2-minute, 3-minute video across multiple platforms, basically at 10 a.m., 11, 12, and they're getting hundreds, if not thousands, of views, which leads back to people contacting us for product, for buying, investing, and going from there. Okay. And like I said, start with one new thing, one new platform, and do it. And then add a second platform to it. This is where the world is, ladies and gentlemen. You can either embrace this or decide not to and eventually go extinct like the dinosaurs did. Unfortunately, most educators out there, most real estate folks don't focus on the marketing side. Their idea of marketing is sending out letter campaigns or postcard. That's not going to get it these days. Okay. You got to market smarter. All right. Like, we're helping a friend of ours with a rehab project, and the realtor is great, not very smart. So we're going to put a QR code out there where people can scan it to look at the view of the property, takes them to listing, it captures their information. You got to have a website these days for marketing. It's just important things to do to help you get the word out. Okay. Any questions about marketing before we move on? All right, so let's talk about how to structure your note business. We've talked about how to find and how to fund, and then the marketing side, but how do you structure your business? Are you buying in your own name? Can you use a DBA? Should you get an LLC? Should you be a C Corp? Let's talk about that. Now, how do I structure my note business? Well, you're going to need to use probably some sort of entity. Now, if you're going to buy with your IRA and just buy with your IRA, yes, you can just use your IRA. Totally fine. If you're just going to do it as a hobby side thing, all day long, buy with your equity trust for the benefit of John Smith. Okay. Thing about that is it's going to put your name out there on the county records. So you may want to create an IRA LLC, or you may want to buy in your LLC. If you're going to be using other people's money, use an LLC. If you're going to be buying in bulk, you probably may want to use LLC with a combination of trusts, or you may want to go to an S corp. It all depends what kind of assets you have. If you're starting off, then just use an LLC to begin with. Okay. I don't want to keep more than $1 million in assets in any one single entity. All right. So it doesn't mean go buy an LLC for every note you buy. But if you're buying non-performing notes, you can use an LLC or a series LLC to buy those notes. And then when you hit about $1 million, then go create a second LLC for asset protection to divvy things up. Okay. If I have an investor brings 250K or more to the table, we use a separate entity for them. Okay. We're going to keep your deals and assets separate from your partner's deal. So if you already have a real estate property, keep it separate in a different LLC than what you're doing with your note deals. Okay. We keep performing notes separately from our non-performing. We keep rental property separate from everything else. If we're buying a larger asset, a larger deal, it may have its own LLC. If you're buying commercial, definitely in a different entity. We have an education side of what we do and marketing side, so we keep that separate. We have a management company that handles a lot of stuff, so we keep that in a separate LLC. Okay. Yes, you can just use your self-directed IRA, but it's not smart to fund your own name. We all know about asset protection. The Consumer Financial Protection Bureau is no longer there, but there are other third-party organizations at the state level that if a borrower files a complaint against you, you want the complaint going against your LLC, not your IRA. Okay. You don't want to buy it personally. If you tell me, I'm going to buy my own name, I'm going to tell you, go buy it from somewhere else because we're not going to sell it to you. You're stupid to do that. Okay. Some counties are actually suing trustees, like in Michigan and Ohio, are suing the actual IRA trustees for lack of back payment. Even though it's funded in their IRA with an IRA number, they're suing the equity trust, the Quest, and stuff like that. No, Quest is not around anymore, but Quest, it was one thing we found this out is that they were getting sued by Wayne County, Michigan, like 10 different times because investors used their IRA by a note or property, but they weren't paying the back taxes. So Wayne County was suing the company. And so they were forcing people that were going to buy in Michigan to use an IRA LLC. Okay. Of course, if you're using funding partners or joint venture partners, you want that to be in a different LLC. Like you can sometimes get checkbook access to the IRA LLCs to help speed up things, but most IRA companies are pretty fast about funding a deal. Okay. You can use trust with your own stuff, but if you're using other people's money, I wouldn't use a trust for individual notes. I mean, I guess you could say that the LLC owns the trust for one asset. It would be one thing you could do, but it's just extra paperwork when you go through the foreclosure process. Okay. You do need to document what you're doing. Having an LLC is not just about a trip to the Secretary of State's and the tax ID number. So there's different transactions, different funding things you want to do, all sorts of different transactions to track. Even if you're a one-person LLC, it's important to do that. That's why we recommend Laughlin and Associates, who've been around for 50 years, to help you in tracking your LLCs, to setting up your LLCs, to helping with your asset protection and structuring your estate, your portfolio, your wealth. Okay. Helping make sure that when you buy notes, you're not violating the corporate veil, so that when you do get sued, because we will all get sued at some point, making sure everything is good and clean. They do a great job with helping you track monthly your expenses, documenting the documents and transactions that you're doing to make sure that it's all papered up. They do a great job of structuring estates, whatever you're looking for, trusts. They can help you out with that. They do a twice a year event called Magnify Your Wealth. MagnifyYourWealth.com is an event that's going on here upcoming in San Diego. Great event to go to. Highly recommend going. Not only is it a great place to network, but you're also going to raise some capital there as well too for you, but learn a lot. Okay. And if you go to LaughlinUSA.com, you can get signed up today. Make sure you tell them Scott sent you, and they probably give you a little bit bigger discount. Okay. All right, let's go through different exit strategies when it comes to buying notes, because there's different ways to technically skin a cat, skin a note. 10 ways to skin a note, as we like to say. So longer exit strategy video, you want to go watch that there, about an hour and a half long, well worth it to check it out. With notes, you can wholesale notes just like you can in wholesale property, flipping contracts. Actually, I believe flipping notes is much easier and safer than flipping property, because a lot of states are starting to crack down on wholesalers. Okay. You don't need to have a license to wholesale a note. You don't. But you're only going to make a little bit of money compared to owning the note or buying the note for yourself. You make a flat fee of like $500 a note. Sometimes it's a point like it. When we are brokering or wholesaling performing notes, we'll just charge 1% of the funding amount. We're helping move a portfolio, maybe 2 to 3 points on the asset if it's a non-performing note. Okay. You can do double closings if you're doing 2 contracts. If you don't know the buyer or don't trust the buyer who's buying it from you, to make sure you're protecting your source. When you trust the buyer, we'll usually just use a signed fee agreement. Hey, here's the loan sale agreement and a signed fee agreement so that, hey, when you wire funds into the seller, the bank, you're going to wire us our wholesale fee. Okay. In some cases, if you don't trust the buyer, you may want to use an escrow account where they fund that money into it. So if you're buying a note for 45, and they're buying it at 50 from you, they wire 50 in your escrow account. You wire the 45 out to the bank. Bank sends the documents to the buyer. You take your $5,000 minus any escrow fees. Okay. It's not a traditional closing of the note. Okay. There's no title updates. No title report, no closing traditionally. All right. You're not going to go to a title company. I'm going to close a note. They're going to want to get title insurance, get paid on something. You're not getting new title insurance because since we're buying institutional debt, the title insurance is still in place. Okay. So no reason to do that. So it's just a wire transfer or using your real estate attorney to handle that escrow, the IOLTA account, what they might use. Okay. Thing about being a good wholesaler is that you know your market, you know your deal, and you know going to market it, so you might as well buy it for your own self. Okay. Now, whenever you buy a non-performing note, the servicing companies, first thing you do is that they're going to reach out and try to get the borrower to start reperforming and start paying on time. Okay. You need a licensed servicer to do this. You don't need to be collecting debt. It's illegal for you in some states. Some states will allow you to self-service. Don't do that. It's a bad, bad thing. Okay. Your servicing company will help with collection of payments, applying the payments to right back payments. They're going to do right party contact, which is borrower outreach. And that's what RPC stands for, right party contact. You instruct the servicers. So that's what you're paying your servicer for each month, the $25 a month or $95 it's not performing. And they're going to instruct the servicer like, hey, I need you to collect the regular payment plus extra if we're going to restructure the deal or allow the borrower to stay in there if they're behind. That may be a lump sum on the front end and the monthly payments, or maybe partial lump sum and then partial extra each month. It just varies on how you structure it. Okay. You can do loan forbearance agreements. It all depends on what you can do with that borrower. But yes, getting the borrower to start paying on time is the first strategy. Okay. If they can't start paying on time, then you can do a trial payment plan or a loan modification. We always do a trial payment plan for 12 months before we move it to a loan modification. So it turns into a long-term capital gains versus a short-term capital gains. But we always want that borrower to bring something on the front end. 4 months is a minimum of payments, if not more. It's going to be at least usually 12 months. Sometimes we'll do 6 months if they bring a huge chunk. It all depends how far behind they are, right? If they're only 6 months behind, well, then bring 3 months of the back payments and we'll spread the other 3 months over the next 6 months or 12 months, okay? You can do a whole variety of adjustments, adjust the balance, forgive or reduce back payments, adjust the interest rate. Like I said, never go straight to loan mod, do a trial payment plan, making sure that borrower can follow up. If they can't follow through on a trial payment plan, then you go to the foreclosure process, okay? If you do it for a loan modification immediately, that resets the dates. It restates all the lateness. So if you do a loan modification, they make one payment and stop paying, guess what? You got to wait till 90 days now of 3 more months of non-payment before you start the foreclosure process. If it's a trial payment plan and they don't follow through in the plan, you return the payments and finish the foreclosure or start the foreclosure, okay? But we'll have the borrower sign the trial payment plan and the loan modification. Your attorney or servicer can create the stuff for you. You don't need to be creating it. If you have an idea, like when we're buying a portfolio of notes, we'll send a spreadsheet over to the servicer and say, hey, we're buying these 12 notes. Here's what we'd like to do with these borrowers. A, B, or C. The servicer will instruct you when they talk to the borrower, hey, here's what the borrower can do, and go back and forth. Sometimes you'll get a loan payoff where the borrower will pay you off. They'll cash out their 401k if they get a hard money loan. You can do a reduced payoff, a settlement, sometimes we've done payment plans over 90 days for them to pay off the note. They're not going to go get a traditional loan. So they're non-performing. It's been reporting their credit in the last 24 months. Don't let them tell them, well, I'm going to go refinance the loan. Well, you're not going to refinance your loan because you're late and the bank's not going to finance you. If it's your primary residence, you're not going to get a hard money loan. Now, if it's an investment property, they could go get a hard money loan. But if it's their primary residence, they're not going to go get a hard money loan, okay? Understand that, what type of asset it is, and how they finance to begin with, it will help you determine if they can get you paid off. Okay. And if they've got a retirement, they can go, borrow money from their 401k to pay you off. Okay. You'll handle the payoff and settlement with the servicer and providing the payoff that's good through such and such date. Usually what will happen is the lender borrower will then wire the funds to the servicer will then wire the funds to you. Okay. Now, you being the bank, you can allow the lender to do a loan assumption. Let somebody else come and take over the loan payments. Okay. We're not creating a new note. They're taking over the existing payments. It may be a family member, a friend, potential investor. We'll have them fill out a loan qualification form, but we're not creating a new note. So we don't need to go get a MLO to do that. Okay. We're not refinancing. They want to refinance, go let them refinance. Okay. We don't mind modifying the terms sometimes, but we're not going to create a new note. All right. Most of the time, we're going to keep the existing payment, unpaid balance, and the terms of the note, unless they're going to bring a sizable chunk to the table. Okay. And it's pretty easy. The borrower can just quit claim the property over to that new borrower, and they start paying. If they don't start paying, we can still foreclose on them. All right. Take the property back. We can short sell a property if they owe more than the property's worth. They're upside down. We as a bank can allow the short to take place. I mean, we're still going to make money because we paid for the note well below what the property's worth. So if they owe more, we can allow them to list the property at 80, 85 cents on the dollar and then approve the short. Now, the reason we say listed at 85% of the fair market value of the MLS is that we want them to get offers coming in. So this is for full value. Nobody's going to come look at the property, which says third-party approval required. We want to motivate borrowers or buyers to look at the property to chase that 10, 15% of equity potentially and get in a multiple offer situation when the bid's going up. Okay. We're not booking showing appointments around the bar on this case. They're going to have to allow the realtor to come show the property at any given time. And yes, you can have the right to reduce the realtor's commission, to 2% each side if you want to. If there's no showings, nobody's shown that looked at the property in 2 weeks, we'll move to do a deed in lieu or cash for keys. All right, or consent to judgment. And yes, you can write off the short by issuing a 1099 to the homeowner for what wasn't collected. So if they owed 120 and you agreed to reduce payoff at 90, you can still send them a 1099 for that $25,000. Okay. Deed in lieu, cash for keys is often referred to as friendly foreclosures. We'll let the borrower walk scot-free. We'll give them, this is where the borrower will deed the property back to the lender or you being the bank. So you take the property over. You want to make sure there's no second liens on the property. You're basically forgiving them of the debt in return for them giving you the property. We'll do anywhere from $500 up to $10,000. We've done more. We actually, one of our students just actually did a $75,000 cash for keys because there's $200,000 in equity. So instead of taking the property to foreclosure, they did a deed in lieu with a borrower, forgave them of their debt, but gave them $75,000 of their equity so that they could take the property back, fix up, and make more money in selling it as an REO versus risking the foreclosure sale. Okay. Usually we want the property to be in good condition, clean, swept. It avoids a foreclosure on that borrower's credit, which is important. But you never want to accept this without first checking title, making sure there's no other liens on the property, no second mortgages, because if you accept a deed in lieu, that second now becomes the first there in the driving position. You own the property, but now you're going to have to probably pay off that second. So if there is a second place, you would do a consent to judgment and then finish the foreclosure. Okay. But this is, it happens about 10 to 20% of the time on the deed in lieu. What we're usually going to see is it's occupied. We're probably going to get them back on track 60, 65% of the time. And the other 35% would be some sort of mixture of foreclosures or deed in lieu. It all depends if the property's occupied. If it's vacant, you're going to have to foreclose probably 50% of the time and deed in lieu the other half. Okay. But always take internal photos, always pull title before you do a deed in lieu. Just show up a realtor, a friend, to walk the property, make sure it's something that you want to take back. Now, if you've bought a note and worked on it, you can always turn around and sell that note to another note investor. You've created value in knowing which way the exit strategy will go. If it's a difficult borrower who's dragging things out, or it's a state with a longer foreclosure time frame, you don't live there, but you bought it at 40 cents a dollar, maybe it makes sense for you to turn around and sell it at 50 cents on the dollar to somebody else. You make your 10% and move on. Okay. We've done this multiple times. Help people who wanted to get performing notes and the borrowers won't want to perform. Like, well, sell it, turn around, sell it, make 10% and 30 days, it's a 40% annualized return. Okay. Many funds that buy portfolios, that's their whole goal, buy a portfolio, do a very heavy workout campaign for 90 days to the borrowers. Those that do not respond or tell them to go pound sand, then they look to move those assets off to other note sellers or some other note buyers at a quick markup. Okay. If you're looking for a buyer for note, you can use local meetups, local realtors, local investors in the area, see if they're interested in it. Pretty easy to find folks that are investing through LinkedIn or Facebook or Bigger Pockets, stuff like that. You can mark it as a handyman special, or it's a note deal that you know exactly which way it's going to go. Okay. We always like to work with investor-friendly realtors who have people that understand what we're doing and understand that you're getting this at a deal well below like a pocket listing than what you would buy as a regular asset. Of course, you're going to foreclose a chunk of the time. It's just going to happen. Like I said on the beginning, a non-judicial foreclosure is faster, cheaper. It's going to start like $1,000 to $1,500 to foreclose. A judicial foreclosure is going to go through that legal process. The court systems is going to be $2,500 or $3,500 or more to do that. You're probably going to try to sell it at the foreclosure auction. You, being the bank, you'll determine the opening bid or your final bid. Basically, you're going to give bidding instructions to the attorneys. If I can sell it at 80-90% of value at the auction and I'm making a good chunk of profit on it, just be done with it. Let somebody else take over the evictions. Let take somebody over the fixing it up and going from there. Okay. If it doesn't sell and you take it back, it's now an REO, a real estate owned asset by you. You can do what you want with it. Rent it, sell it, owner finance it, whatever you want to. But the foreclosure process cleans the title, wipes out all the liens. I mean, taxes are going to be paid, but it's going to wipe out any seconds, any other liens on there. There may be some utility liens that follow the property as well. Okay. If you do take the property back and you're in the process of fixing up and selling it, make sure you slap a lien on the property to secure your investors' money. Okay. It's important to do that for asset protection because there are unethical people out there who will go slap fake liens on a property, hoping that you'll pay them off $10,000, $15,000, $20,000 to remove the lien instead of waiting the 90 days for the title company to wipe it out. Okay. Number 10 is selling the reperforming note. If you've bought a non-performing note and got it back on track, guess what? You can now sell it. If it's got 6 to 12 months of on-time payments and some lump sum on the front end, you have a lot of buyers out there that will look for that stuff. But you want to have a third-party servicing company servicing the note, tracking the payments to add value. If you're self-servicing, you are not going to get good value for it. Okay. You can only sell it too if you're modified or doing extra payments. Only sell it off what the true P&I payment is, not the P&I payment plus the extra per month. Okay. Also, you're going to sell it off just the UPB balance, not the full legal payoff, unless there's a ton of equity above. Okay. The bar still might be behind, but if they made 6 to 12 months of on-time payments, that's a good thing. And they may have made the most recent payment, made a payment this month, but it went to 6 to 12 months ago. That's still okay as long as they've made 6 months of on-time payments. Okay. Now, some sellers out there, this borrower expressed interest in reperforming, but if they haven't made a payment, it doesn't mean they're reperforming. I want to see 6 to 12 months of on-time payments to even consider buying it as a reperforming note. Okay. Now, kind of the bonus is a bankruptcy note. If a BK loan is actually good for us, if it's a BK Chapter 13, it's a payment plan. If it's a Chapter 7, we're taking the property back. All right. In a BK Chapter 13, the borrowers are often going to set up a payment plan over 60 months. If you see on a spreadsheet or tape that there's a BK case, go to pacer.gov, which is where all the bankruptcy filings, and type in that case number. You'll be able to download everything about that bankruptcy and get all this due diligence, see what the payment plans, if they've made any payments. There have been times we bought a portfolio notes at a BK loan. We walked into getting a chunk of payments already. Okay. If you bought a non-performing note and the borrower files bankruptcy, you're needing to have your attorney, your bankruptcy attorney, evaluate that and see if the plan makes sense. Okay. But there are BK Chapter 13 loans are sought after. They've got some Wall Street firms that are looking for these things because it's pretty much a performing note for 5 years. If the borrower pays off, great. Or if they file bankruptcy, you can actually kick the mortgage out of the bankruptcy if they just paying on time. Of course, if they don't fall through the payment plan, you can discharge the note and finish the foreclosure. All right. Now, if it's a Chapter 7, you're basically going to foreclose. or get a deed in lieu from the bar and move on. Don't the bar. Some people think, oh, I filed Chapter 7, I get to keep the house. No, you don't keep the house. You got to sell the house or give it back to us. Okay. A deed in lieu or foreclosure bar does not comply. Okay, that's the thing to keep in mind when it comes down to it. All right. Any questions about the exit strategies? And the great thing is having a servicing company will help guide you through that process, help you work through the foreclosure process. We're available for questions for our students and members out there, ladies and gentlemen, at talkwithscottcarson.com. If you're a monthly member at $97 a month, well, you can pick my brain multiple times on some stuff. We'll help guide you through the process. Okay. One second, everybody. Let's do this. Let's take a 5-minute break. It's 10 minutes at the hour. Come back at 15 past the hour. Okay. We get into the final stretch here. All right, let's dive into some of the things that we need to look at to see if a note is a deal or a dud. Now, we've got a longer due diligence spreadsheet, or not spreadsheet, well, it's spreadsheet, but due diligence document that helps guide you through this process from start to finish. But this is some of the things to keep in mind when looking at it. Things you definitely want to consider. You want to make sure that you get access to the servicing notes direct from the seller and the servicing company. You want to look at the payment history. You want to look at market values of the property, what the days on market are for a property based off the BPO. Because if it's 90 days, it's a whole lot different than 390 days, right? What kind of estimated repairs it's going to need. You're not going to get inside of these properties unless it's a reverse mortgage or the property is listed. But keep in mind, it's going to need some payment. You're going to need some stuff to fix it up usually. What's the foreclosure time frame? Where are they in the foreclosure process? What's going on with the neighborhood? Is it in a good area? Is it a crime-ridden neighborhood? Look at the zoning violations or issues that are taking place too. The property. Look at city government issues. Is it good city council? What's going on with the issues? Like, is there a homeless hotel going right down the street? Is there gang violence? All that kind of stuff. Okay. Look at the crime map. Some cities have a huge issue with crime map. I've been shot at twice in Gary, Indiana. Chicago, Chirac is a rough place. Okay. Look at the size and population of the city and where it's located. Look at the exterior condition of the property. Is it in good shape or does it need work? Is there some pride of ownership? Is there landscaping? Are the kids' toys? Is there a flag out front? Okay. Or is it more rural? What's going on with that? These are all things to look at. I even look at, see if a city has local colleges. If it's a small city, like I mentioned, Belton, Texas has a small university, University Mary Hardin Baylor. There's about 3,500 people going to school there. Well, that means if I could buy there, if I'm within a couple miles of the university, it could be a good rental if I have to take it back like that. You know what I mean? And of course, you got to think, make sure does the asset meet your strategy? You're going to look at, you want cash flow, you're going to look at performing or reperforming notes. You're going to get larger checks with deed and liens or cash for keys or REO sales. Okay. You're going to grow your assets with rental portfolios or taking property back and doing new note originations. You want to definitely avoid weird assets and unfinished projects. If it's not your cup of tea, just say no to it. Move on. Okay. We always like to make sure that the assets have 3 profitable strategies. They've all got to be basically profitable for the most part. Now, here we know if it's occupied, definitely we want to make sure that if we get it reperforming, it's going to be a good return. Now, if it's vacant, we know they're not going to be reperforming. Okay. If it's a reverse mortgage, we know they're not going to be reperforming. So those are the exceptions to that. But otherwise, if we do get a deed in lieu and cash for keys, is it going to be a positive return for us? If we have to foreclose and do an REO sale, is it going to be positive? Is it going to make sense for us to take it back and list it as an MLS property? If not, and it makes our money's too costly or expensive, don't do the deal. I don't like rentals, so I don't consider that. But some people like, oh, I'll take it back and rent it out. Some people say, well, I'll take it back and do a new note origination. And I'll keep the note or sell the note off. And that's fine. Do whatever you want. Okay. If I can't get the bar back on track, we'll look to foreclose, pay off our investors, and then take the profit and go buy new stuff. Okay. The big thing is to keep in mind too, also has legal started. Ask to speak to the attorney, ask to see the attorney's notes. Okay. Look at and review the servicing notes, the collateral file for hardship letters in the background of the borrower. I mean, if there's hardship letters in the collateral file, the borrower will tell you exactly what they're trying to do, what's going on. If they want to do a loan mod and it makes sense for you to do a loan mod or stuff like that, just go ahead and approve it. Like, yeah, let's do that. Okay. Check bankruptcy if it's BK on pacer.gov. Look at your statute of limitations too. Each state has different time frames for what you can collect on back payments. Okay. If a lender hasn't, if a bar isn't paid in 12 years, you probably can only collect them in the last 4 to 6. Okay. So that means 8 years of potential back payments you can't collect on. Doesn't mean you're going to pay on that. So keep that in mind when you see these huge legal balances. Also, is it in a state that offers some sort of safe harbor to the lender, where if you foreclose, you don't have to pay off the HOA fees? Like Florida has a huge safe harbor. Good thing for if you're buying the note. Colorado and Nevada both have it as well. Okay. In Florida, the safe harbor law is basically if you're buying a note and foreclosing, you're only going to pay either 12 months of what the HOA fee is or 1% of the original sales price of the asset. It's a big difference. Okay. All right. Let's dive into the due diligence side of things more so. Okay. All right, note due diligence. It's basically divided into three areas: the borrower, the property, and the collateral. Okay. Got a longer due diligence. We have a whole due diligence masterclass there. Take a look at it, but you can check it out at noteduediligence.com there. On the borrower due diligence, you're going to look at the servicing notes. Have they been responsive? Have the borrowers been able to have the right party contact, or they've been in trouble, pain in the ass? Okay. Look at the previous loan documents. If it's the original, if it's a institutional debt, you probably have the original loan application of the 1003. See what they did. What else did they own? Any other property, other investments, 401k. We talked about the bankruptcy reports. That's part of the personal side. Look at white pages or spokey.com to try to find current phone numbers. If we're buying notes, Occupied will use Spokio and white pages to find a phone number to call, make sure it's a working number. We won't call to talk about buying their note or owner financing or restructuring the note, but we call to see if there actually is a working number. And that's good information that we can give our attorney. Okay. We'll do some social media sleuthing. Are they online? Is the borrower online? We've seen assets where the borrower said they were going to either go to Disneyland or pay their mortgage. So they went to Disneyland. Well, guess what? We didn't modify their mortgage, then we foreclosed. Or another one where we're buying a note on a property where the borrower was a professor at the University of Missouri. And he broke his leg, couldn't teach. So we were like, okay, we're fine with that. We saw another one we were buying where the guy was going through a transition. Basically, he was paying his mortgage. He wasn't paying his mortgage. He was paying for his down payment on his breast implants. Okay. You learn a lot by what people post on social media. Okay. We also had another one with the borrower said she couldn't pay. And she was a pastor, but she was bragging online about she bought a brand new Cadillac and her high-end clothes. I was like, no. Homie, don't play that. You're going to pay or you're not going to stay. Okay. Look at the neighborhood. Look at the family members. See if they're around. See if they're in context or stuff like that. Okay. And then also pastor, president, employers. If it's on the loan 1003 or see who they work for. If they list who their employer is on their social media, you can get an idea if they're still working or what they make per hour, what they can afford or not. Okay. Now, of course, the property, everybody's pretty familiar with the due diligence of the property, values of online versus in-person, as is versus 30-day quick sales. Exterior condition is important because it looks bad on the outside. It's probably not going to look any better on the inside. Okay. Look at the market conditions. Like I said, days on market. What interest rates have changed things up quite a bit with days on market dragging out, inventory increasing. Okay. But always, always, always put eyes on the asset before funding. Okay. Know what you're buying. Know what it looks like and be comfortable with that, okay? And obviously check recent nearby sales and comps. Make sure the comps make sense. All right, we were looking at an asset in Georgetown a couple of weeks ago, and the comps were low, but they were all over. They weren't even in the same area. They were like miles and miles away. I'm like, well, that's not a real accurate comp, okay? And you're going to check comps by getting a broker price opinion. That's going to cost you. Or you're going to have a local realtor, pull a comparative market analysis. Now, if you need to order a BPO, you can do so at our website. We'll go through that in a few minutes for you. Check the taxes, okay? Call the county, go online and enter online and check what's owed, and then call the county to find out. See if there's any pending tax sales, okay? Call the local zoning department, code enforcement, see if there's any liens on there. Like I said, neighborhood activity is important on the property. Like Memphis is definitely one of these cities you got to look in street by street. Is it a good or is it a bad street, okay? If it's been listed on the MLS in the last year or two, or if it was a rental posting. We bought notes on properties that had a for rent sign on a rental website. We were able to see interior photos and see they've done a lot of work. We're like, oh, we're comfortable buying that note. Okay. Look at the rent rates. That's important. If you have to take the property back, is it going to make sense to keep it as a rental for a period of time? Okay. Also look at what's for sale in the area. You have a lot of Airbnb short-term rentals that are going on the market now that are going to create issues with you trying to sell your property, especially in Florida and other areas. Okay. Look at the HOA or the condo association limitations. Especially you're buying in Florida or as a condo, can you rent it out? You may not be able to rent it out. It may be 55 plus. Maybe there's like we were going to buy a note on a condo in Florida, but there was for us to keep it, there was be a $30,000 payment to the golf course that it was in and around. You had to pay that to the buyer. That's kind of limits selling the asset. Okay. Look for any special assessments on condos or things going on in the area. Okay. Look at the crime maps. We talked about that before with Chicago, Gary, stuff like that. Like I said, Gary's the only city I've been shot at twice. Seriously. Shot at twice. I might get shot at accidentally here in my own neighborhood in Austin. Who knows? It's different these days, everybody. Different out there. More about the property. Most of the time, you will not get internal access. You're not going to be able to do a property inspection before buying the note. You know, if it's listed for sale on the MLS, then hire a realtor. Then you could be able to go take a look at the inside. Okay, but you're not going to hire. You're not going to get a property inspection before buying the note. You're buying the note, not the property. Use Zillow values for upfront due diligence, but then order a BPO or get a realtor to drive by it once under contract. You can also use AVMs, automated valuation models, using NAR RPR for free to pull quick values, but it does not count. This does not replace a BPO. Okay. Call the utility departments. This is a must. Okay. To see if power's on, see if electric is on, see if the gas is, gas, water. If that's on, great. If they're turned off, they're turned off. Okay. If it's turned off, somebody's probably not living in the property. I mean, that doesn't mean they won't be. I've seen people live in properties with power and water turned off for months before, but it's good to know if the power is on, it's probably being taken care of, especially in colder states. Okay. If you find that the value is below what they said, you can always fade, reduce your bid. If the value comes back low, it's not a big issue. You're just going to provide proof of that. But always have somebody you trust, whether it's a realtor, you, friend, family, go by and put eyes on the asset. And when it comes to collateral, there's due diligence to look at your collateral file. Make sure their original loan documents are there scanned. You're not going to get the hard file sent to you. You're going to get scanned copies ahead of time. So you got to go through that and review it. There's a checklist for that. Make sure that there's every assignment or allonge is in there. If the note's been sold 4 times, there should be 4 allonges that go along with all 4 of the assignment chains. Okay. Make sure the deed of trust matches up. See if there's a previous appraisal in your collateral file. It's scanned. You can take a look and see what kind of interior condition it was in. Okay. Like I said, look at the previous loan application to find out a lot of information about the borrower, what they do beforehand, what's their spouse do, retirement accounts, other real estate. And like I said, you won't get the hard collateral file, the actual physical copy, till after funding. It may take 30 to 45 days. So do not fund if you do not get a soft copy first, like a PDF scan copy. You got to get that before funding. If you don't get that, don't fund. If there's an assignment missing, do not fund. Get that fixed before you fund. If there's an allonge missing, that's not a big deal. You can get that done. But if there's an assignment missing, get that fixed before you fund. Note investing is a team. It requires a team. Now, your team, it doesn't all going to be you. There's going to be a variety of vendors that you use, let you leverage their expertise, their energy to get things done. All right. Now, you're going to use the servicing companies to be the number one teammate. Now, there's a variety of different servicing companies. Some will work with new investors. Some will allow one notes. Others want a minimum monthly payment coming from you. You know, like BSI wants at least $5,000 a month coming for you to work with them. So don't work with them if you don't have $5,000 worth of servicing. Okay. All right. But there's plenty of servicing companies out there. All of them suck at some point. The idea is to find the less suckies. Massive Management's okay. Allied Servicing is pretty good. FCI is okay. They're automated. If you don't have an automated process, I wouldn't touch FCI. Not good for non-performing because it's almost impossible to get somebody to talk to at FCI. Okay. SN Servicing is not bad. A little bit more expensive, but they'll work with smaller portfolios. Okay. There's Land Home Servicing, Covey Finn. There's a whole variety of different servicing companies out there. Okay. You're going to use a title company or a company to pull O&E reports, owner updates for you. Okay. This is to see who owns it. You don't need to go back and pull a full title report from when the property was created. You just need to pull it back to when that mortgage was created for you. That's why we like institutional debt, because usually there's clean title to the point where that bank finance. If you're financing or you're buying owner finance stuff, you probably want to go back to creation, make sure everything's clean title wise for you. We've got a service Baldwin advisory group that we help out with. If you need to order O&Es, you can order directly through Baldwin or through us. And we work with Dickie Baldwin over there to get it done. You can actually order directly from our website. We'll walk you through that. There's another company, Pro Title USA. You can also order. They're a little bit, they're not quite as fast. They're usually doing a lot more higher end orders, like 10, 15,000. But we've got a couple vendors for you to choose from. Also, valuation BPO companies. You can order those directly through us on our website. Foreclosure attorneys, we can help you find a foreclosure attorney and go over to Legal League 100 as well. Oftentimes, servicing companies will have their own list of foreclosure attorneys that work from. You can either use them or use your own. I prefer to hire my own and have that attorney sign up with a servicer. That way I have constant communication with my attorney. A lot of servicing companies want you to go through them for communication with your attorney, and I don't like that. Okay. But legally100.com is a website you can find attorneys across the country in every state. Or you can use referrals from other investors as another source that we use. Okay. There are special servicing companies you can use to actually be more aggressive on the borrower outreach. All right. Coast Angels was a company we used out in California. There's Singer Law Group. Daniel Singer, he's merged with somebody else as well recently, still does this stuff as well. But they're a right party contact. We actually hired somebody in-house that used to work for a servicing company to be more aggressive on the workout when we buy notes. Okay. We can make right party contact within a week versus a month. Often get stuff modified and payments in 30 days versus waiting another 60 to 90 days. Okay. You're going to have a collateral review and storage company. I say if you're going to start off with just a few notes, just put them in a file cabinet somewhere, or put them in a fire safe box or waterproof box and put them in a storage unit. Okay. But if you need somebody to review your collateral files, Joel Markovitz is our buddy that does that. He will review that for, I think it's like $149 a file for you. It's about a 72-hour turnaround time. CSC is a company out of Dallas. I usually want you to have 100 files with them to store and review. Richmond Monroe is a company out of West Branson, Missouri. They'll review your collateral files, tell you what's missing, actually help you fix it. And they'll also store your files as well. A lot of servicing companies will store your collateral files. I wouldn't do that there. I would keep it somewhere either with you or like a Richmond Monroe, who's that's their job. Servicing companies, I've had companies lose my collateral files, and that's not a fun place to be in. You're going to need realtors to pull comps, to list your property, to drive by, use realtor.com. We also have a realtor network to help you out with that as well. Property insurance companies, there's 3 or 4 to choose from. Ross Diversified is out of Orange County. There's National REI Group out of Kansas City. There's US Lloyd's, US Risk also out of Dallas that we work with. You're going to need property preservation companies that can go in and turn the water off or protect it if it's vacant or it's during the winter. Most realtors will have that, but we've got companies that'll do that. And if you want to order your due diligence, let me share that with you here. You can go directly to our website. Oh, where's that here? Did I have that pulled up or not? Here. Pretty easy to do. Just going over to weclosenotes.com. And let's see here. Let me share this for you. So you go to weclosenotes.com, that's our website, and just go over to where it says vendors. Okay, if you click on vendors here, click on vendors. And you can order your BPOs. Now, not all these buttons are working yet. We have we're in the final processes of putting in forms, or where you click on it and fill out the forms. But click on here, like order your BPO here. This will take you to a jot form, fill out your information, and we'll get it ordered to you. If you've got multiple assets, like a portfolio of notes you're buying, just upload the Excel file here for you. But fill out the information here for you, get it sent. We'll get it ordered. And then once it's delivered, we'll collect payment before we deliver it to you. But you don't have to order it right now on the front end side. But once it is submitted, even if you cancel your bid or cancel your stuff, here's what we charge, because it's going to cost us to order it for somebody else there for you. So keep that in mind. All right. Same thing with O&E reports. You can order that here. Same thing, takes you there to a form to fill out. Also, if you have a note for sale, you're trying to sell a note, you can fill out sell your note here. If you need a new LLC or want to get in touch with Laughlin, you can fill out that information here, and we'll direct you directly to that. So kind of the nice thing here for you, make it a one-stop shop for you. Your BPOs, your O&Es, your collateral reviews, property preservation. We're in the process of getting that filled out. If you want to open a self-directed IRA of some sort, we have a form there to submit to American IRA for you. If you order skip tracing, we do that in bulk as well. Sell your note, we have availability for you to fill out that information so we can help you move that note. If you want to order IRA investors in the county and states here, we'll do that for you as well. If you need to hire a VA, we have a form there for you to fill out. It should be live later this week, so that we use Riva Global, but gives you some ideas of what you want done and options. And then that way they're more precise in what they respond to you on, because we've worked a lot with Riva Global by actually sending training videos to their VAs to help instruct them on how to pull IRA investors, how to do due diligence on notes and stuff like that for you. Okay. So that's that. If you go to week close notes into the vendor tab and fill that out for whatever you need, you'll be off and running. Okay. All right, let's go back here. The last aspect here. We've covered a lot over the last 2.5 hours with you here, guys. And so the next phase here is what comes next after the class. You're not going to learn everything about note investing in 2.5 hours. That's why we have multiple features for you to learn, whether you want to do it on your own or you need some help with coaching to make it happen. And we've got different things to fit your budget. Okay. So what comes next? So you've gone through this class. If you're ready to rock and roll, the next thing we would highly recommend you do is sign up for our 3-day workshop. Go to notebuyingfordummies.com or go to our website and click on the 3-day workshop. This is something that we've been teaching for years, and it's what is the nuts and bolts, the A to Z of how to find, fund, and flip notes, non-performing notes direct from banks, and it's our bread and butter. It's what's made me the note guy. It's what helped us successfully train hundreds, if not thousands, of investors to buy notes. And listen, everybody, it's not saturated. There's still plenty of opportunity. Millions and millions of non-performing notes out there for you to buy. Millions and millions of reperforming notes for you to buy. Millions and millions of commercial notes for you to buy if you want to dive into that. So just to give you a bit of an idea of the last couple months of people that we've trained, John and Veronica Gore, that out of New Jersey, they closed on 20 notes, seeing a 22% ROI in their portfolio. Cal Ewing's bought about 12. Actually, I think he's bought 13 or 14 notes, 7 performing, 4 non-performing, and 1 deed in lieu he's going to make $150K in profits on. Pretty good, right? He's from Canada. Brodeur, another Canadian, bought 14 notes, 10 performing and 4 non-performing. He's making 50K profit in just one of the notes that he's foreclosing on out of Lansing, Illinois. Larry Hoffman's bought over 50 notes. Catherine Bell's bought 20 plus notes, made 6 figures. Keith Holland's bought 4 notes, 3 performing, 1 non-performing, and the 1 non-performing made him over 25K in profit. Right? Paul Riley's bought performing notes from us. He's seen at least a 12% cash and cash return on his portfolio. Demeter Armstrong has bought 1 note and did other things, but he still made money on his 1 note there. And Sterling James has actually bought 2 notes in its 90 days and 28% ROI in one. And it's going to make a 36% ROI in the second one. He just closed on yesterday. We just found out. So this is just a snapshot of a few folks we've helped. We like helping people because here's the reason we teach. We make some money teaching. Yeah, we make some money. But it turns into deal flow, turns into tapes coming in for us. It all turns into funding partners for us. It turns into people to buy notes when we get listen. Who wouldn't want to make a 28% cash and cash return in their IRA, right? There are great opportunities out there if you just know where to look or not and are willing to be coachable. Okay. You don't have to rely on somebody else to feed you notes that is going to charge you 10, 20, 30, $40,000 on top of what you paid to get learned. All right, to learn from it. Our next 3-day class is just in 2 weeks. This is actually, it's a weekend after Easter, 25th to the 27th. And we're going to throw some things for you to get signed up for it. You're going to not only get replays to the actual class afterwards, but you're going to get replays to the October class so you can start learning. That's a $299 value. You're going to be part of a 4-week implementation class that we follow up for 4 weeks after the actual workshop, every week for 4 weeks to help you put your business in play. Okay. And take advantage of what you learn to implement it more. Okay. Lawful and Associates have given us an entity secret class that you're going to get basically for free. Okay. We're going to give you the wholesaling notes and calling banks masterclass and the due diligence masterclass as well. The 3rd class I forgot to put on there. But those are 3 classes that will help you take your business to the next level right there as well, besides just the Note Buying for Dummies. We're going to give you our special web series, 20 by 20, how to find and fund notes. It's a video training series of a $600 value that we created. Every day is a lesson on how finding and a lesson on funding. All right. And guess what? You can bring your spouse or partner at no additional cost to learn during the 3-day workshop. Now, this one is online. We taught an in-person one back in February, Valentine's Day. And we teach this class about 4 times a year. 2 in person, to virtual this year. So it's the virtual time right now. That's why it's a reduced price for you. Normally our class, I mean, yeah, oh yeah, I forgot we're going to throw in a note pool for you guys to look at assets as well that you can bid on. All right. Over $3,000 in value there for you guys. Our class is not expensive. We price it so it's affordable for folks to be able to learn, but it is not going to be free. Normally our class, our 3-day class is $997. We are running special since it's the virtual version of it for $497. And it's live. It's me, 3 days with you. I might have 1 or 2 vendors on there to talk about what's going on or help you on your business. It's not a pitch fest. It's literally, like I say, first full day on finding assets, second full day on funding and marketing, and third full day on structuring and exit strategies to make you money. And it comes with a 200-page manual full of contracts, forms, sample things, all for you to use to dive in so that you're a lean, mean note buying machine when you wrap the class. And of course, we're going to hold your hand for 4 weeks afterwards for implementation class. If you want to make offers, we'll be going through some of those offers and help you work your way through closing your first deal in your first 90 days. Okay. Now, like I said before, if $497 is a bit of a stretch, then you want to sign up for our $97 monthly membership. It's noteumbrella.com. That includes access to the virtual workshop. It includes access to past recordings, past workshops. We upload tapes to our WCN crew members. It's $97 a month with a caveat that you need to be around for 6 months. You can't sign up for this for 1 month and cancel. All right, not going to do that. We're not going to play that, homie. You got to be a part of this for 6 months if you're going to do the $97 a month for you. Okay. That's because we do include the class. We also do coaching calls with our WC crew members. You can also book a time for me to walk you through and review your deal before you're making offers on it. So it's really hands-on with yours truly in part of a group. And then, of course, we have our one-on-one coaching. Okay. Now, our one-on-one coaching obviously is a bit more of an investment, but it is going to help you climb that mountain and become successful because I'm going to hold your hands and kick your ass along the way through your first deal. It's at least 8 weeks of one-on-one training calls we do weekly via Zoom, morning, afternoon, and evening with you and your partner or your spouse. We're going to give you over 5,000 asset manager contacts, emails, LinkedIn, phone numbers for you to start marketing to. We're going to introduce you and give you our top 12 hedge fund managers that send out deals to us on a regular basis. You just got to reach out to them. But we're going to make the introduction so that you're at the top of the list, okay? You also get a year of the WCN membership included. We're going to help you with raising private capital by either A, helping you find investors in the markets you're buying in or in your own market. You're going to have VIP access with me, being able to communicate with me. You know, so maybe it's weekly, maybe we jump on a phone call twice a week, or as you have a deal that's working through, okay? After you go through those 8 weeks of coaching calls, sometimes it's 10 weeks, sometimes it's 12 weeks, it just depends on what's going on. You're going to come and spend 2 days with me here one-on-one in Austin as we really ramp up your access to deals, to cash flow, to making offers. We're going to help you do a lot of things. And that 2 days will vary depending on what your strengths and weaknesses are. And this is me working with you, not outsourcing it to some VA or working to somebody else. Look, an employee cannot teach an entrepreneur how to be successful. I'm an entrepreneur. I've been doing this for almost 20 years. I've been a real estate investor now for 24 years now. All right. We know marketing, we know raising capital, and we know how to fund deals. We know how to find deals. All right. Find good deals, not shitty deals off of some stupid website that's been sitting around for months. Okay. We want you to close deals, and I'm going to work my ass off in those 8 to 10 weeks of coaching calls to get you to make your first offer that's making you 12, 15, 20% on your money. Okay. After you come spend 2 days with me, we schedule as need be. You book on my schedule as need. Some people still want to meet weekly for a few weeks. Others want to just meet as they need be. It's completely up to you. 6 months after the class, 6 months after the 2 day, we have you book a Zoom call with me. We do a half day or a full day just to see what's going on. Where are you at? What do you need the most amount of help with? What can we do to transition? Here's the thing. My one-on-one coaching students, guys, they're my family. I'm going to find you deals. I'm going to feed you deals to make sure that you make up what you paid for in the coaching. And that's the most important thing is if you're going to sign up for me with coaching, I'm going to make sure and put deals in front of you that make sense. Okay. And if you want to get signed up for coaching, just reach out to me, book a time on my schedule at talkwithscottcarson.com. I'm glad to help you take your business to the next level and go from there. Now, is it a bit of a investment? Yes, it is. Our one-on-one coaching is $24,997, so it's right at 25 grand. We credit what you paid towards the workshop. So if you paid $500 towards the workshop, we'll credit $500 off there for you. And we do have payment plans. Okay. If you want to do a pay in full, we'll drop it down to $20,000 even for you, give you a $5,000 discount for paying full in 30 days. So you can even break that up at 10 grand now and 10 grand in 29 days, right? If you can't afford that, but can afford a payment plan, let's say 5 grand down and a couple grand each month, we'll do that for you as well. We also have such a good success rate. We also have a third party that provides financing for you over a 24 to 36 month financing plan. That's if you basically, it's through Ease, company called Ease Finance. If you've got 2 years on your job, you're making 40K or more a year, and have a 620 FICO or greater, they can stretch that 25 grand over 2 to 3 years. There's monthly payments could be as little as $500 or less, depending on your credit. There's no prepayment penalty, and there's no payment due for 45 days. So you could actually be halfway through. Think about that. Your weekly coaching calls, getting a deal closed, and then pay off your coaching before the 2 years are up or 3 years up. So this is a great way to leverage some funds for you. Keep that 25 grand that you would pay, or 20 grand you'd pay, use that towards notes. Get you close a deal, let's get that paying for your monthly payment. That's what we often will work on. It's like, okay, I got this monthly payment. Let's find a note that'll pay for my coaching, and let's do that. Okay. But that's one option for you. We'd love to have you be a part of our note coaching family and go out and close some deals. We really love our students. We love how proud, we're very proud, and I'm more proud of them closing their first deal than any deal that we close. So I'm old hat. I want you to be successful, and there's plenty of inventory and plenty of opportunity out there if you're a note investor. So if you're interested, like I said, reach out to me. We'll give you some discounts on there. And like I said, we are here to help you get rock and rolling. So get signed up today, notebuyingfordummies.com, or go to our website, weclosenotes.com, and click on the link. We'll show you how to do that. If you just go back here, back to our website. Right, here we go. Share, and then just go on over here to the training and type in the virtual note buying workshop. That'll take you there. Click on that. That'll take you to the checkout page, and the discount's already applied to the $497. Okay. Any questions, comments, concerns before we let you go for the day? We'll be breaking down multiple tapes on the workshop as well for you. But we'd love to have you be a part of this. If you get signed up today, we'll have an email out to you this evening or tomorrow with a replay to October's workshop. And we run a no questions asked, money back guaranteed. If you sign up for the workshop, you attend the first day on that Friday, and you're like, this is not for me, no problem. We'll refund your money back, no questions asked. Okay? So what do you have to lose? Nothing. Okay? Nothing at all. Everybody get signed up today for a workshop. We're glad to have you be a part of it. This is an online class, Arthur. Our class in April is not an in-person. It's online, all via Zoom. Okay? So unless you want to come, you could make a hotel reservation at the Courtyard by Marriott and watch in room. But this is just Zoom. This is an online virtual workshop. The next in-person workshop probably won't be till November or early December. Okay. Does that answer your question? It's okay. You've learned a lot today. It was like drinking from a fire hydrant, right? Good stuff. All right. Well, everybody, that is what we've got for today. We're going to wrap it up here for you. Thank you so much for coming on and spending a couple hours with me going through our note weekend training, our note investing 101 class. We hope to see you in 2 weeks at our workshop, our virtual note buying workshop. Get signed up today at $497 before the class goes up, because the price changes the last week of the class if you don't get to. So come on, get signed up before Easter, and we'll help you find enough Easter eggs on your way to becoming a note investor. All right, everybody. Have a great week. Enjoy the rest of the weekend.